up their own tariff walls when it comes to China?
No, I think Europe is very aggressively against formal tariffs. So, but I do think that once you've started kind of challenging free trade, that the whole thing is a more fragile edifice, and so it'll splinter a bit because we just get all these knock-on effects.
Quick final question for you, Kit. Euro dollar 114 at the moment. We all remember the days pre-negative rates back in 2014 when they were implemented that summer. We remember how stubborn the euro was, stubborn euro strength. What are we going back to? What kind of world, Kit? Are we going back to the pre-negative rate era of, say, 120, 130, 140? How do you think about that?
I can't see how, in real terms, that the euro can justify the levels of sort of certainly the 130, 140 levels. I think they're gone, frankly. I think we'll see 120 again. I think that's the bit I can manage in my head. But the European economy needs to develop much stronger underlying growth to get above that, for a lot to stay above that.
Kit, appreciate your input. As always, sir, thank you. Kit Jukes there of SocGen. Euro dollar at the moment, 114.
I feel like the euro dollar has just been on a roller coaster. The start of the year, everyone, including Kit Jukes, put out there this idea that we could see parity when it comes to euro dollar. And now, off to the races because of Trump's policies, really forcing Europe to act.
This is frustrating for a lot of people sitting here this morning. The way things are today could change tomorrow. They could change in 5 minutes' time. The fate of trillions of dollars of markets all around the world and the price of them in the hands of the social media account of one person at the moment. This can change very fast one way or the other.
And I'm thinking, we're almost at 100 days of Trump 2.0. And we're basically back to where he came into office on everything he was talking about on the campaign trail. China is not going to be as high as 145, but it's not going to be 0. 10% is right now the base case while all these deals potentially are getting done. What if you just turn off the Truth Social and look at the entire policy perspective, that stool, the 3 legs, and think about where the long-term trajectory is for this administration, for this economy?
If you're able to do that, and if it is positive, it's still pro-risk, pro-growth, then the equity market for sure is in a better place. If you're able to do that, and doing that at the moment is incredibly difficult to do. Equity futures at the moment, session highs up by 2.5%, adding to yesterday's gains on the S&P 500. In the second hour of Bloomberg Surveillance, in just a moment, we'll catch up with David Leibovitz of JP Morgan, Monica Guerra of Morgan Stanley, the Bundesbank President Joachim Nagel, and Torsten Slok of Apollo. From New York, this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
It's still premature to talk about a fundamental regime shift. We're not there yet.
There's a lot of cultural and economic structures here that will hold together. It's not going to all just come apart.
Actual economic growth has not really been impacted yet.
There are still really important strengths in the U.S. model.
We got to be careful not to think of it as an existential long-term crisis. We're at peak policy uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
One address from the President of the United States sufficient to unlock some big gains in the equity market worldwide. Some soothing words on China and backing off from the criticism on Fed Chair Jay Powell and the threat to fire him. Equity futures on the S&P 500 firmer by 2.5%. On the NASDAQ, up by 2.9%. In the bond market, important move at the long end of the curve. This is your Chair Powell rally. Yields are down by 12 basis points on 30s, 4.7557. And in foreign exchange, after a lot of dollar weakness, a touch of dollar strength. Euro dollar 114, that currency pair negative by 0.1%.
This is exactly what the market wanted to hear yesterday on both tracks, whether or not it was the Fed, whether or not it was on China. We saw the President of the United States take his foot off the gas pedal and really walk some of these comments back. Never did, he says, had the intention of wanting to oust Chair Jay Powell. That's not his plan, but he did say now would be a good time for the individual to cut rates, and that's all he's trying to get at when it comes to China. Quote, very nice. We're going to be very nice when it comes to Beijing. And the rate is not going to be as high, Jonathan, as 145%.
Let's stay on China. The ball is moving in the right direction with China. This came from the press secretary yesterday, setting the stage for a deal with China, doing well on a potential deal with China. Is there any evidence that they're negotiating with China at all?
Not at the moment. The only evidence we have is a story, a Bloomberg scoop, that China has put out a list of demands that they would like to see. One, backing off some of the hot rhetoric coming from this administration, some cabinet officials that Beijing wants to see the president rein in. Also, select a point person to do these negotiations. Now, that hasn't been public. The administration has done anything to select that. But if you read the tea leaves, it is clear there's now one individual in this cabinet of rivals, as Terry Haynes calls it, that is driving trade negotiations, and that's Scott Bessent. And potentially, that has Beijing excited.
It's a change of tone. We'll see if the tone sticks. Equities up, session highs by 2.5% on the S&P. Coming up on the program, David Lebowitz of JP Morgan as President Trump backs down, Bundesbank President Joachim Nagel from the IMF annual meetings, and Torsten Slok of Apollo expecting recession if these policies don't change. We begin this hour with stocks rising as President Trump strikes a conciliatory tone. David Lebowitz of JP Morgan Asset Management writing, we expect a further slowing of growth in the coming months. With risk still elevated, we maintain our modest underweight to equities. David joins us now for more. David, good morning. Good to see you.
Good morning. Thanks for
Does that view change with those comments just yesterday?
So I think what's important to recognize is that the increase in the effective tariff rate, even if we stabilize somewhere in the mid-teens, is still fairly significant relative to where we were. And so it would be very surprising to me if we see, what we were forecasting at the start of the year, which was more trend-like growth, 2% for 2025 as a whole. I think somewhere between 50 basis points and a full % of real growth is a reasonable expectation for this year. And again, if you look at some of the sentiment survey, I think that weakness is going to begin to show up in the harder data and further reinforce the idea that, we're not going to necessarily have a recession. That's not our base case, but we're also not looking at terribly strong growth given what's happened out of Washington.
Kimberly Clark, GE, complaining about higher cost pressure across the supply chain. How do you think those costs will be distributed? Do they absorb that through margins, lower margins, or do they pass that on to the consumer, the end user?
So it's interesting. I think the thing to watch here is what happens to import prices over the next few months, because that'll give us a good sense of whether that cost is being eaten by the importer, passed along to the consumer, or whether it's being borne by the exporter, which is what the administration has told us could potentially happen. Early signs are that companies are allowing it to eat into their margin. They're passing it along to the consumer. This is exactly what we saw in 2018 with the first round of tariffs. And so it would be very surprising to me if we didn't see at least some upward pressure on inflation going forward.
It's the interplay between margins and the labor market that I think is interesting. If they start to say things like cost management, which some people might translate as firings, how do you see that playing out in the months to come?
So I think what's interesting is that when you listen to what corporations have been saying up until this point, they're very much sitting on their hands, right? They're not investing a whole bunch in their business. They're not hiring a whole bunch of people, but they're not really cutting back significantly on CapEx, and they're not laying people off either. The claims data is helpful as a guide for what's happening there. We look at that in conjunction with JOLTS. I think the fact that we have a layoff rate that's low and a quit rate that's very low suggests that the labor market is in some sort of equilibrium here. And frankly, if we see a bit of upward pressure on the unemployment rate, probably not the end of the world, and aligns with the Fed forecast. It keeps the door open for the Fed to ease policy later this year.
Earlier, we were talking about how my family in particular is trying to get ahead of potential any tariff increases in prices. And Jonathan brought up a great point. Are these people worried about prices going up? Or are these people that you see in the retail data, are they worried about losing their jobs?
So I think it's more about they're worried about prices going up. And one of the things I always come back to is this idea of, common man inflation, right? So if you take food and energy and shelter and put those together, that's what the average American is experiencing. The average American has experienced a price shock here, whereby the overall level of prices has increased. And while the pace of that increase is beginning to slow, you now have this risk of tariffs on the horizon. And, recency bias is a very powerful thing. People are saying, I remember the last time prices went up a lot. I'm going to go try to get ahead of that because I'm not sure that I'm going to get laid off, but I'm also not sure that my wages are going to keep pace with the rise we see in prices.
When it comes to corporate America, you said that at the moment they're just waiting on the sidelines. They're on pause. We've seen a number of executives go to the Oval Office. Lots of calls are being made. At the same time, soothing words now coming from the president. For corporate America, do you think this is peak uncertainty?
So I frankly think that peak uncertainty was a couple of weeks ago closer to Liberation Day. I think now what we're trying to do is walk through a very foggy forest, and we have a sense of where some of the trees are, but we don't have a great sense of whether we're veering off of the path. I mean, the reality is that we've seen outsized volatility over the course of the past couple of weeks. I'm not sure that that's going to pause anytime terribly soon, but I do think that the administration is getting a better sense of what the impact of these policies will be on the economy and how that aligns or misaligns with some of the things that they campaigned on last year.
What do you want in the portfolio that helps you sleep at night? What is that now?
So we've definitely moderated risk, and we've gone overweight duration. We think that that's advisable, but if you look at the way markets are trading, they're really just trading in a range. And so to me, this is where you want to keep one foot on either side of the line. You want to have that hedge. You want to have that duration, because we do think that if there's a big growth shock, bonds will rally.
You think duration still works in a down market? Because again, this morning, what we're seeing is a pretty tight correlation between risk and the long bond.
Yeah, that is a very fair point. I think that is more a reflection of policy uncertainty and building risk premia into treasury yields and equity prices overall. I think if we get hit with a growth shock, if we have a recession, bonds will rally in that environment. And so that's really what we're hedging against. We're not sure that inflation is going to reaccelerate in any material kind of way. We may get a level shift from tariffs, but that should work its way through over time. We think the bigger risk is on the growth side. That said, recession not our base case. Do we want to sit here and get whipsawed by equities up 3, down 3 every day? I mean, no, that's not fun for anybody, but we like the idea of holding things like high yield credit. They allow us to still have risk in the books, and we can frankly clip that coupon, which at 8% and change is fairly attractive.
Never mind getting whipsawed whipped around by equities, we're getting slapped about by the 10-year bond and a 30-year treasury. When does that settle down? What do you think is going to lead to that settling down?
So it's a really unusual environment, right? Because you have a weak dollar, you have U.S. equities that are underperforming the rest of the world, you have the relationship between rates and equities that you just highlighted. I mean, I think what we need to see here, at least in terms of a first step, is concrete evidence of what one of these trade deals is going to look like. If they're as close with Japan and India as it sounds like they are, and they can put a blueprint out there where the rest of the world says, okay, I kind of get what the administration's looking for, I think that goes a long way in just putting up some guardrails and helping people understand what the rules are going to be going forward. I mean, American companies are incredibly dynamic. They just need to know the rules of the playground.
You describe this as a sentiment issue, basically. That's what I hear from you. Some people are describing this as a rewriting of the rules, a rewriting of the rule book for portfolio management as well. Are you pushing back against that? Do treasuries maintain that traditional role in a portfolio at a time when other people are rethinking where else to be? Bonds, gold, elsewhere.
So I think that when it comes to duration, you can definitely diversify the duration position into places like Europe, where you have the ECB, which is probably going to be a bit more proactive in terms of cutting rates. You have an overall growth profile, which is a bit more modest. And if the U.S. continues to slow, that'll likely lead to slower growth in Europe as well. And so spreading the chips around definitely makes sense from a duration perspective. I'm not sure we want to rewrite the rules of portfolio management. I still think stocks and bonds over the longer term will have a negative correlation, but I think the volatility of that correlation is going to be much higher because a few years ago we unlocked the inflation genie and now everybody's worried about things like stagflation. We've seen bonds are not a hedge in an inflation environment.
You mentioned a few things just now, saying that tariffs will be one price shock, the fact that we do have yields coming down, particularly this morning. What does this all mean for Fed Chair Jay Powell?
So I think Powell, to me, has been very measured, and I think that he's dealing with this very appropriately. He's basically standing by what the Fed has been saying, which is we're ready to ease policy if the labor market weakens further. If the unemployment rate doesn't go up from here, I think it's going to be very difficult for the Fed to justify cutting rates.
Even if inflation comes down.
Even if inflation comes down, because I think if you look at the Teal book from 2018, right, they do worry about some sort of feedback loop evolving, even though tariffs are technically a one-time level shift, right? If prices are rising, you ask for higher wages, that's how you end up with a problem. And so I think if they don't see the weakness in the unemployment rate, they will be a little bit hesitant to engage in further cuts. But if you look at what's going on with the data and you think about some of the stories coming out of Washington around things like Doge, I do think we'll see further pressure on the unemployment rate going forward, and I do think 2 to 3 cuts this year is a reasonable expectation.
It's the bias of the committee right now. You see it in all the speeches repeatedly. We heard from Neil Kashkari, the Minneapolis Fed president in the last 24 hours, who made the argument that I've heard a million times over the past few weeks, pledging to anchor inflation expectations. That seems to be the priority. That's what they want to communicate in this very moment.
And probably also because not so distant to memory, this was team transitory and concerned that they were behind the curve when it comes to inflation and the price pressures that were faced on American consumers.
Well, they certainly were very behind the curve. David, it's good to see you. As always, thanks for dropping by. David Levitz there of JP Morgan Asset Management. This is where the bond market is. And once you know where the bond market is, you know where equities are. In the bond market right now, yields are down by 14 basis points on a 30-year treasury. We're down by close to 10 on a 10-year. And in equities, once you know that information, your equity market's near session highs. Equity futures on the S&P up by 2.5%. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Hecker. Say, Yahara.
Hi, John. The 3-day public viewing for Pope Francis has begun. This comes after Catholic cardinals performed the ritual ceremony to transfer his body to St. Peter's Basilica, where he will lie in state. His funeral is set for Saturday morning and will be attended by many world's leaders, including President Trump. Meanwhile, a check on AT&T shares. Those are rising 4.2% in the pre-market after the company delivered strong first quarter results. The carrier added 324,000 mobile phone customers in the first quarter, a stark contrast to Verizon, which reported a loss of subscribers. AT&T also reiterated its 2025 full-year guidance. Another stock rising in the pre-market is Tesla. Those shares are now up more than 7% after Elon Musk said he will pull back significantly from his work with the U.S. government next month. Musk made the announcement after the company reported first quarter profit and revenue that fell short of expectations and backed off its earlier forecast that sales would grow this year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, the president playing nice.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice, and we'll see what happens.
Everybody's playing very nice. Up next on the program, Monica Guerra of Morgan Stanley from New York City this morning. Good morning.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Yesterday, the biggest one-day gain in some 2 weeks. This morning, we add to it. Equity futures on the S&P 500 higher by 2.5%. On the Russell, we're higher by 2.6%. On the Nasdaq, we're up by 3%. In the bond market, some comfort. Look at this move at the long end of the curve. Yields down by 13 basis points on a 30-year, 474.87. Under surveillance this morning, the president playing nice.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice, and we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
So here's the latest this morning. President Trump signaling he may be backing down from his hard stance with China, following comments from Treasury Secretary Scott Bessent that the current standoff is unsustainable. Bloomberg's Tyler Kendall joins us now from Washington for more. So Tyler, it's a change of tone. How sustainable is that change of tone?
Yeah, hey, John, it's one of the biggest questions. Is this softening in tone actually going to stick, as the White House really does need Beijing to come to the negotiating table, and demanding that Xi Jinping pick up the phone and call directly doesn't appear to be working. But to be sure, White House officials still contend that they need to see a serious rebalancing in trade when it comes to China, and tariffs aren't going to go down to zero. Now, the White House press secretary yesterday did suggest that they were, quote, setting the stage for a deal with China, but fell short of saying that those negotiations have started, and our reporting indicates that at this point they really haven't. And we should note that China's foreign ministry did say in a statement this morning that the door was, quote, wide open for talks. But at the same time, Bloomberg News had reported last week that Beijing has some preconditions here, including that President Trump not be the one to be that point person to lead the negotiations going forward. Now, there was some relative signs of optimism yesterday after Bloomberg News had broke the story that Treasury Secretary Scott Bessent told a closed closed-door investment summit yesterday on the sidelines of the IMF that he thinks both sides are going to need to de-escalate soon because the current situation amounts to a trade embargo. People familiar say that Besson expressed optimism that a deal can be reached and that tensions could cool in the coming months, but still cautioned it could take 2 to 3 years to ultimately reach a larger trade deal. John, just for context, took about 18 months or so last time under the first Trump administration to negotiate the Phase 1 China deal, and this is considered to be much more broad in scope.
Tyler, a lot of talk, not a lot of action when it comes to China, but there is action, and there are meetings taking place when it comes to other trade partners. What are you hearing in terms of who can get a deal, maybe even a blueprint, in this 90-day reprieve we have of those reciprocal tariffs?
Right. Well, Amory yesterday, the White House press secretary, put some numbers on it, said that this week alone, the White House is going to meet with 35 countries, and that so far 18 have actually put forward proposals on the table that the White House is considering, but again, fell short of saying that there actually has been any real solid momentum towards reaching a deal. There is preliminary reporting that we could start to see perhaps some frameworks emerge instead of actual concrete trade deals to signal that there is progress moving forward, and we know that some of the countries being prioritized for that include, of course, Japan and India, those countries that are geographically close to China and that the U.S. sees as important allies to help shore up ties in the region. And we sort of got a preview of that yesterday when Vice President J.D. Vance was in India, and we had the readout from his meeting with the Prime Minister where the USTR said that they had finalized a roadmap to getting towards a deal. How much actual concrete direction or tangibles that we get from what that actually will lead to remains to be seen, but we do know that the U.S. is pushing for more concrete commitments. For example, when it comes to boosting U.S. imports into the country, we'll have to see whether or not any of those actually do come to fruition.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Here in New York, Monica Guerra of Morgan Stanley. Monica, good morning. It's good to see you.
Good morning.
Here's a question for you. Who are they negotiating with right now?
Who are they negotiating with? It sounds like they're talking to Asian countries. There's been discussion about potential coalitions to come together in response to China. So while we're playing nice, we have to see if that's really the case. You know, other places where we're seeing negotiations and a willingness to talk, right, is with the EU, Germany in particular. So I do think that it's broad-based. The IMF and World Bank forums, perfect time, right, to get everyone together and start to sort those things out. The thing I really want to caution investors with is, you know, while we have this positive news, it doesn't mean anything's done, and we still have a long road to go.
So let's talk about the IMF World Bank meetings. We'll be heading down to Washington later on this afternoon. Are these trade partners aware of what they need to do? Are they aware of what the ask is from the administration?
I think it's clear that they don't. You know, if you saw over the weekend with Japan, they said we came forward with the negotiation, and we still haven't heard anything back. And so when we're thinking about this, we have to, you know, our guess is as good as anyone, but I think there's a way to sort of break down the framework. So you have your first bucket, tariff to tariff, tit for tat negotiation. Then you have the non-tariff related trade concessions with trade balances. You know, do we get more countries to import defense from us? That could be a potential play. And then the geopolitical sort of positioning. And when we're thinking about a potential Asian bloc versus China, that would be an example of that. So you could get one or all, right? But I think that those are the most obvious tools. And we could also be surprised, right? And get something in return that we didn't necessarily expect. So that's the basic playbook and framework that we've been thinking about it when we're trying to guide our investors.
It's that last point that I want to learn more about. The president over the weekend put out 7-10 points of what he views as tariff cheats. And he said transshipping, this idea of transnational. How important is it for other countries to strike a deal with the United States saying we are going to push China out? And are they willing to do it?
It sounds like that there is some willingness. This is the first time where I've seen that there could be potentially willingness, and that's been signaled, you know, out of these meetings. As far as the importance of that, I think it is important. To what extent then becomes the question, and how would China retaliate? So when I say we still are in this period of uncertainty, we're not at maybe the peak uncertainty at the beginning of April. We are getting more clarity, but I would say magnitude, right, is the most important when we actually see what does a coalition look like, what could that response then be from China?
The response from China is going to be interesting. Does China double down? Or does it actually help the U.S. get to a better trade agreement with China at the end of the day?
It could get them to the table, right? Because that's one of the biggest issues that I would say, has been sort of stalling, right, this negotiation with China. We've been watching this escalation, and at what point do more tariffs matter, right? It becomes these broader coalition-type deals, stonewalling of China, and that could actually bring forward, a true discussion. It is interesting that, Trump isn't invited to the table of that discussion, but the fact that they're willing to have them is, I think, key to sort of moving this along.
So what is he doing right now when he says things like, we're going to be very nice, they're not going to be at 145%? Is he just wish casting that Xi Jinping calls him?
Potentially, but one of the things I think is positive about that as well, we don't have the full framework, and if things, do go sideways, right, that could change the narrative. There is essentially, he's starting with the ceiling, right? He's saying, we're at the top, we want to come down. What that looks like, again, we don't have those details, but to me, that is encouraging.
Much was made about what the Treasury Secretary said behind closed doors just yesterday in Washington. I have to say, based on the reading that I've done, the reporting that I've seen, it's pretty consistent with what he told you only a week ago.
Exactly. He said it was unsustainable when it comes to these levels. When I told him, what do you make of the Commerce Minister saying they're jokes? Like, they're not a joke, but I agree they're unsustainable. And then he said there is a big deal to be done. And that's exactly what he told these investors behind closed doors.
So the deal falls somewhere between 145% and zero, but it won't be zero. That's a pretty big range, Monica. Have you got a base case?
Yes, a base case, I mean, you can only look to, the April announcement at 54%, right? So, maybe that's as far as we come down, right? We sort of have that opening bid, then we have the sort of the ceiling now. Maybe we return back to that opening bid. So again, it's anyone's guess, but when we're thinking about, the investment implications, and Morgan Stanley's recommending that we take a sort of defensive rebalancing against all of this. We're not jumping all in and calling this any kind of victory. Again, being really cautious around potential market volatility.
We heard this from our previous guest as well. Monica, it's good to see you. Monica Guerra of Morgan Stanley. If you end up with 10 baseline across the board, a universal tariff, say, and then 54% on China, if you told people that would be the trade story at the start of the year, that's not the story they would have liked.
It was not the story they would have liked, but they love it now, given the maximalist approach we saw from the president. It feels like we're playing bowling, and now the bumpers are up. We know on one side how high it could be, on the other side we know how low it could be. If you split 145 in half, you're looking at 72.5%. The president campaigned on 60% China, 10% around the United States, and right now, that looks like it's going to be the direction of travel, where he started on the campaign trail, and he couldn't have been clear when he was out there campaigning for the presidency.
How will that reshape the economy? What does it mean for the data, and how will markets respond? Right now, favorably, positive by 2.4% on the S&P on the equity side, and on the bond side, yields dropping by double digits at the long end of the curve. Up next on the program, a view from Europe. Check this out. The Bundesbank president, Joachim Nagel, joining us from the IMF meetings in Washington. Sitting down with Lisa in just a moment. That conversation is just around the corner. Live from New York City this morning. Good morning to you all. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising chorus conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equities here near session highs up by 2.4% on the S&P, and the Nasdaq 100 up by 2.75. Let's get you some morning movers with 2 hours until the cash open. Here's Danny Berger. Hey, Danny.
Hey, John. Got some earnings to get through this morning. First, let's start with one that reported after the market closed. The big one, Tesla, up some 7%. Initially, when they reported, the numbers were not great. They missed on everything from earnings to operating income, but it was in the call when Elon Musk talked about the fact that he would refocus to Tesla and away from Doge. We got this kind of rally again. Shares up 7%. The likes of Dan Ives, the big bulls, upgrading their Tesla forecast. Dan Ives calling it a new chapter. Some earnings over the past hour. We heard from AT&T, a huge beat when it comes to how many mobile subscribers that they added. More than 320,000. The expectation was for around 250,000 for the quarter. Those shares up nearly 4%. Also just underscores how poor the numbers were from Verizon yesterday. They had bigger losses when it comes to subscribers, so it looks like AT&T has been able to take a chunk out of their shares. Also, moments ago at the top of the hour, we heard from Philip Morris, the cigarette maker, and their earnings. Now, we've heard from a lot of companies either declining to give forecasts, maintaining it, or even giving a range. Here's the rare example of a company that is upgrading their forecast. Philip Morris pointing to the really strong sales of smokeless tobacco products. So they're saying the macro environment isn't affecting them. Where it is affecting them is in deals, also announcing in their earnings this morning that they would be shelving the $1 billion spinoff of their cigar unit. John.
Danny, appreciate it. Thanks for the update. More from Danny later this morning. On our radar this morning, our top stories, President Donald Trump appearing to back down. Trump saying he'll be, quote, very nice in trade talks with China and that he has no plans to fire Fed Chair Jay Powell. Elsewhere, the White House is nearing general agreements with Japan and India on trade. Sources telling Politico more details will be announced at a later date. The Wall Street Journal also reporting the US is negotiating terms with the UK. And finally, Intel is set to announce plans this week to cut more than 20% of its staff. A person familiar with the matter telling us here at Bloomberg the company is looking to reduce bureaucracy. This would be the first major shake-up for the company's new CEO, who took over just last month. That name is up in a pre-market by close to 5%. Let's turn to the nation's capital, where world leaders are gathering for the IMF and World Bank spring meeting. Standing by is Lisa from the IMF headquarters with a special guest. Good morning, Lisa.
Good morning, John. I am here at the International Monetary Fund. It is a very different series of meetings. There aren't the same kinds of banners outside. It's a more subdued kind of feeling, and yet there are people collecting in Washington, D.C. for the first time since President Trump was inaugurated from all around the world, including the president of the Bundesbank, Joachim Nagel, who joins us now. I'm so glad to see you, and I want to start with this question of how different are these IMF meetings?
I guess this year, this meeting is a very special one. I think the world economy is in a very delicate situation, and I will use this time here to learn a little bit more what we can do to make it better, to make the economy running, have a better understanding what's going on, and there are really a lot of uncertainties.
One of the uncertainties is what's coming from the United States in particular when it comes to tariffs and how much that not only is a ramification for the U.S. economy, but also the global economy. How are you thinking about tariffs and how much they could depress growth, say, in Germany?
I said a couple of months ago, when it comes to tariffs, I was of the opinion that this will trigger a lot of problems. And now we see how the problems evolved over the last couple of weeks and months. And so we have to have a better understanding how we can find, let me say, a kind of a compromise, a kind of a level playing field that brings us closer together, because tariffs are not a good policy, this is for sure.
If they stay, is there a sense that it gives you more room to cut rates?
I think, first of all, I guess we have to take into account as central bankers also tariffs. What does that mean for Europe? I guess when we're talking about monetary policy in the Euro system, we are on a good path. I guess we can come close to price stability over the course of this year, and this is good news. But there's a lot of uncertainty. And so we said last week, because of that, we have to be very cautious. We have to wait what might come, how this uncertainty might evolve over the next week. So we have this meeting-to-meeting approach, and this, I guess, is the best way to conduct monetary policy.
Since the beginning of last year, since a peak rate of 4.5% at the ECB, you've cut rates 7 times, a deposit rate of 2.25%. Is that neutral?
I will not speculate about neutral. I guess only in hindsight we really know where neutral maybe was or maybe is. So I guess I have to look what the numbers, the figures are telling me, and there I see a lot of, let me say, good news when it comes to the inflation story. When we talk about economic growth, there's a lot of more uncertainty because tariffs are not good for economic growth. So the latest news that we got from the IMF here, we know that this is for Europe not good news. We are in a stagnating situation. So stagnation is the picture for this year, maybe recession for my country, for Germany. I cannot exclude a slight, let me say, recession this year. So this is what we have to work on, and monetary policy can only give us a good indication when it comes to a good direction, when it comes to stable prices.
The threat of tariffs has had an unexpected effect in markets of actually weakening the dollar pretty substantially and strengthening the euro, which on the margins could actually be a disinflationary force, especially if you're importing goods from overseas. That would lead to lower effective prices in euros. Does that give you some breathing room to actually cut rates in response to potential weakness if that reduces some of the inflationary pressure? I guess
it's much too early to really come to the final conclusion. What does this tariff scenario mean for both sides of the Atlantic? It seems to be, at least for the moment, that the price of that tariff decision has to be paid in the United States and not in Europe. It seems to be that prices might go up much more in the United States compared to the European Union. When it comes to economic growth, I think the picture is pretty much the same. It's also a drag on the economic growth here in the United States, also in Europe. But I will not speculate about monetary policy and what we will do next in our next meeting.
How much are you watching what China is doing in terms of any trade barriers from the U.S. causing them to export more of their production, say, to Germany? I mean, potentially lower prices with respect to an abundance of exports to the country.
I think China is an important player here, this is for sure. I guess it's not only for us, the Europeans, let me say, a very uncomfortable situation. I guess also for China, and yes, there might be a scenario that they are looking for new markets, additional markets. Europe was already being a market for Chinese products, but now maybe they can maybe use Europe more compared to the past as an additional market. But as I alluded to already, I think it's a lot of speculation. What does that mean, this tariff discussion? And it's too early to really assess what is the detail in really any aspect. It's much too early.
Just to add to the confusion, if you really are looking for any kind of compass and want to just change everything, Germany has been known for the zero debt break and this idea of not raising the deficit in any capacity. That has changed. We have been talking extensively about spending not only for defense, but also for a whole host of different investments. Does that create more inflationary pressure? Does that just improve the growth picture? How does that sort of influence some of your modeling?
It is important to say that the role of Germany does not change or that didn't change, because the stability anchor of Germany is still there. So as I said, I think we are living in a very complicated world, so it was necessary from a German perspective to do more regarding defense spending. It was also clear that we have to do much more when it comes to overcoming our infrastructure issues. So I guess this fiscal package is an important message to the world that Germany is doing its homework, and we will improve over time. The economy will do much better over the next years. And for me, as a central banker, this is at the end good news.
Well, but is it inflationary?
As far as I can oversee the current situation, it will not be inflationary, because we are coming out of a situation, stagnation this year, maybe a kind of a recession. So it's not inflationary over the next course of the years. It's helpful to the economy, means more economic growth, and this is good news.
One thing that's happened over the past couple of weeks in particular has been this fear of the United States losing its position as the currency of the world, as well as treasuries having this special status. And one thing that we've seen in the flows is a lot of money going into German bunds as sort of the new haven, and we're hearing a lot about diversification away from the United States into German assets. Do you welcome that? Do you think that that would be positive?
Well, I think that it is not good news that there's a lot of, let me say, doubt regarding the safe haven of U.S. treasuries. I think this is not good news. And you're absolutely right. Some of that money went to German bunds. But all in all, we need the U.S. Treasury market as a good, stable market that gives a lot of, let me say, certainty. And we should overcome this turbulent situation, and we should give back U.S. Treasury this safe haven status, because it is not helpful to all of us if there are some doubts, uncertainty around US here about the U.S. Treasury market.
It wouldn't necessarily provide a support, the same kind of privilege of spending, I don't want to say recklessly, but with abundance in Germany, if Germany were to have that safe haven status?
I think Germany, and I alluded to that, is the stability anchor of Europe in Europe. German bunds is a perfect example for this, and this will not go away, but we need a good U.S. Treasury market. This is so important for the financial markets worldwide.
Speaking of which, you're going to be meeting with Jerome Powell, the Fed chair, at these meetings this week. What are you going to ask him?
I think Jerome Powell, he's a great guy. I really admire him, what he did over his career in central banking, and so we would talk about the current situation, yes.
So the current situation is potentially some sort of threat to central bank independence. That was taken off the table to some degree when President Trump yesterday, in response to reporters, said that he has no intention of firing Fed Chair Jay Powell, and that this was media speculation that was run amok, not necessarily any real indication that he was planning to remove him before his term was up early next year. How concerned are you about threats to central bank independence?
So what is important to me is that independence of central banks. This is the DNA of central banking, of good central banking. So we shouldn't, let me say, question to a certain extent that this is maybe something that we could see in danger. So independence of central bank is of utmost importance. And Jay Powell, he is a great central banker. He did a marvelous, good job, and I guess this is also seen here in the United States.
Do you worry about some sort of financial instability if that continues to be called into question?
I will not speculate here, but in a scenario that you just mentioned, I cannot exclude such a scenario that there is then maybe a lot of turbulence coming to the markets if this is in question, and we should avoid that. That shouldn't come as a realistic scenario. We should avoid that. This is of such a danger for the world economy, and so I really hope that there's enough understanding how dangerous this could be.
There's a question about what Europe can do to insulate itself and to draw itself closer, and that maybe some of the finance ministers and central banking chiefs can form something of a closer union to try to fortify themselves away from that type of volatility. Have you seen material steps toward that, to try to establish that type of stability in the continent?
Yeah, absolutely. I think Europe has, I guess, now a better understanding that we have to do our homework, becoming more resilient. We have to implement all what we discussed over the years. I just allude to the capital market union, banking union, maybe a little bit more fiscal integration. So Europe has to stand together in these complicated times. But on top of that, also these meetings here, the IMF meeting, the World Bank meeting, these 2-3 days are so important to all of us to work on international cooperation, so the multilateralism of our work is so important in these days. So I will use these days here in Washington, D.C. to get a better understanding, to convince the partners here that cooperation is key in these days.
In the United States, there seems to be a move away from financial debt or incurring more debt, and there's this concern about the fiscal deficit in a pretty significant way. There is a goal to try to retrench some of the spending over the past few years. In Europe, it seems like there is a move in the opposite direction. We talked about that with respect to Germany, that there is a greater degree of willingness to spend. Do you think that that is appropriate throughout the entirety of the continent, given the fact that there is this desire to try to rebuild and regenerate a whole host of industries?
Let me disagree a little bit here, because I do not see that there is a momentum that we are going away from fiscal discipline. We have still a good understanding in Europe that we are currently in this complicated situation, so we have to do much more compared to defense spending compared to the past. But if that period is history, then we have to come back to fiscal discipline, and this is understood in Europe, and we will go back to that fiscal discipline.
Going forward, do you ever see a time when you can see zero rates again from the ECB, or even negative?
Well, as I said, I will not speculate here. I think we do what we have to do in our next meeting, and this is our mandate, this is our huge responsibility, and we did, I guess, pretty well over the past 3 years, and I'm very optimistic when it comes to price stability. That mission will be accomplished over the course of this year.
So do you think that you are going to get back down to 2% over the course of this year?
Absolutely, yeah.
Okay, and you don't think that necessarily there has to be any material change whatsoever to policy to get there?
No, there's no autopilot. I think we are decent central bankers, so we will assess the data, and then we will find maybe the right decisions.
Joachim Nagel, thank you so much for being with us. Joachim Nagel, the president of the Bundesbank. And John, it is fascinating to see how much people are looking for a sense of stability from the United States at a time where a lot of their sense has been somewhat shaken.
Lisa, thank you. Great work as always. Appreciate the update. On Europe, careful what you're investing in. The latest from the Bundesbank president there. Can't exclude a recession in 2025, the risk of stagnation this year, and maybe worse. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. We start with a check on Boeing. Those shares are up nearly 4% in the pre-market after the company reported first quarter results that beat estimates. According to a statement, the plane maker used $2.3 billion in free cash in the 3 months ending March 31st. That's better than the $3.4 billion withdrawal analysts were expecting. CEO Kelly Ortberg calling 2025, quote, our turnaround year. Meanwhile, Xiaomi is delaying the debut of its first sport utility vehicle after a fatal accident involving its marquee electric car. Sources telling Bloomberg the Chinese company scrapped plans to unveil its YU7 electric SUV at this week's Shanghai Auto Show. A new launch date has not been confirmed. And officials say trade talks between the U.S. and Thailand, due to start on Wednesday, have been postponed. The delay comes after Washington asked Thailand to address currency manipulation and the misuse of certificates of origin on goods. No date has been set for a resumption of those negotiations. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour or so. Up next on the program, the risk of recession.
If we have this cloud of uncertainty coming lower and lower, we actually can see even further reduction in global growth, and then the danger of recession looms bigger.
That conversation up next with Torsten Slok of Apollo.
in case you missed it on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equity futures up across the board here on the S&P, high by 2.3%. Some soothing words from the President of the United States giving equities a lift in the bond market. Yields lower at the long end of the curve. 30s down by 12 basis points. Under surveillance this morning, the risk of recession.
If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret. We actually can see even further reduction in global growth, and then the danger of recession looms bigger.
Here's the latest this morning. The IMF warning trade tensions between the US and China could spark a global recession if uncertainty presses on. Torsten Slock of Apollo writing, if current policies do not change, then the probability of a US recession in 2025 is 90%. Torsten joins us now for more. Torsten, welcome to the program. If current policies don't change, what is current policy and what needs to change?
Well, I think that if we have current policies in place, we will still see empty shelves in stores in the U.S. in a few weeks. Think about how this is impacting small businesses. Small businesses make up 80% of employment in the U.S. economy, meaning that 80% of employment is in companies with less than 500 workers. And think about your independent toy store. Think about your independent menswear clothing. Think about your ski equipment selling store. They are all experiencing significant hits as a result of these very high levels of tariffs. And you're also seeing it in the incoming data. The consumer has been pulling forward spending. So yes, the data we saw on same-store retail sales from Redbook earlier this week did show that yes, consumers are spending more. But on the company side, in the regional Fed surveys, we're seeing a significant decline in new orders. We're seeing significant increase in pressures on costs. And we're also seeing a significant decline in CapEx plans. So if these policies and these tariffs stay in place, then we will have a recession with a very high probability in our view.
Torsten, they're in place right now. How much longer can they stay in place without doing sufficient damage that would ultimately unlock that story anyway?
Well, the response that we're seeing on the consumer side makes sense that from the perspective that consumers are beginning to accumulate goods and increase their holdings and hoarding of goods before tariffs really begin to kick in. Likewise, on the corporate side, we're also seeing a significant increase in inventories among corporates, and that could likely last for, say, a few more weeks. But then once we get onto the other side of that, obviously, and we do have at the same time the expectation, again, with orders being down so much, then I would certainly expect that the economy is poised for a fairly sharp slowdown, especially if tariffs against China stay at these very elevated levels. So yes, developments in the last 2 days have been helpful in the sense that maybe there is some sign that tariffs will come down. But at the same time, let's not forget that a trade deal normally, if you go back in time, takes 18 months to negotiate, because it's not only about tariffs, it's also non-tariff barriers, it's also about the dispute resolution, anti-dumping, also about labor standards, environmental standards. All those things really take time. So the question is, will tariffs come down in the meantime, which will be helpful for the economy? But if tariffs stay at these levels, we will worry about the negative consequences becoming more and more severe.
Torsten, just finally, one thing we've done consistently through this cycle post-pandemic is underestimate the resilience of the US consumer at the aggregate level. Now, I just wonder, Torsten, when I see consumers go out there and buy autos because they're worried about higher prices, that doesn't scream someone's worried about losing their job. Do you think we are overstating the potential hit to the US consumer and understating the resilience all over again, or do you think this is different this time?
I don't think that we are understating the risks here, because think about the domino bricks, how they're falling. The domino bricks are exactly falling the way that the data is coming in. Namely, first, the response will be from companies. Companies are responding very, very significantly to tariffs by saying orders are down, CapEx plans are down, costs are up. That's the first domino brick that ultimately will begin to topple everything if we keep the current levels of tariffs. So we still firmly believe that we have a slowdown coming if we're not getting tariffs down sooner rather than later.
Torsten Slok of Apollo. Torsten, appreciate the update, sir. Thank you. 90% chance of recession if policies don't change. What do policies need to change too? Because right now policies on the trade side are pretty elevated.
Right, they're elevated, but we heard soothing words yesterday, as we keep talking about, from the Oval Office. The president looks like he's ready to negotiate, and I'm not just talking about those partners from the reciprocal tariffs. He said when it comes to China, it's not going to be as high as 145%.
And that's unlocking this move in the equity market. We're higher by close to 2% on the S&P 500. Up next, Scott Kroner of Citi, Dan Ives of Wedbush, Greg Deco of EY, and David Rogel of BlackRock. From New York, the third hour of Bloomberg Surveillance. Up next.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown. Like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes. Do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go? I don't have to go to rodeo for that. That's
no. You could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Clearly, we've seen an unwind in sentiment around U.S. exceptionalism.
Every day, it seems there are more and more reasons to pare back what's been an overweight position across U.S. assets.
We think that growth estimates are still too high. This market hasn't fully calibrated to a lower growth world.
We haven't priced in really a recession. We haven't priced in a meaningful decline in earnings.
In terms of the hard data, it's going to soften. Earnings data is going to soften as well.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Tone shift in the nation's capital. That's the story of the last 24 hours. Backing off from criticizing Chairman Powell too much or threatening to fire him. Backing off on China, playing nice on both sides apparently, and unlocking these gains in the equity market. On the S&P 500 higher by 2.2%, on the Nasdaq up by 2.6%. Once you know the bond market move, you know everything else. In the bond market right now, the 30-year yield is down by 13 basis points, 475, down 10 on 10s. 429.75, and in foreign exchange, just easing that dollar weakness story. Euro dollar right now just about unchanged at 114.16. This from Neil Dutter of Renmac just moments ago. Check this story out. The S&P 500 has shed a total of 719 points on days where Howard Lutnick and Peter Navarro have been the biggest story of the day. By contrast, if Besant has been the biggest story of the day, the S&P has advanced a total of 52 points.
Besant ascent. That's what Neil Dutta has been calling it. The fact that obviously the individual that is driving a lot of this right now, the soothing words we were hearing from the Oval Office, is Scott Besant, the Treasury Secretary. One, on China, he reiterated behind closed doors what he told me last week, that it's unsustainable, these tariff levels, and there is a big deal to be done. And then, of course, when it comes to what the Treasury Secretary called the crown jewel of monetary policy, Fed independence. The president yesterday saying, I never did have any ideas to fire him, just think now would be a nice time to lower interest rates.
So let's think about lowering policy and lowering tariffs. Let's think about where we are right now. So around 150 on China. So the president's saying it's going to be lower than that and higher than zero. What's the landing point? Because that range is ridiculously wide. I know this market's running this morning, but I want to know where we're going to be tomorrow, the day after that, the week after that. I want to know where policy is going to be over the next several years.
Well, it's going to be complicated because first they're going to do the trade deals with trading partners and allies, and then they're going to go to China, potentially as a group, as we heard from Monica Aguirre from Morgan Stanley. When it comes to China, you also have to think about things like non-trade issues the United States wants to get out of China. TikTok deal, also, can China put their thumb on the scale when it comes to things like Iran, when it comes to things like Russia and trying to end some of these wars, hot wars we were seeing in the world? That is why it's going to be complicated. But I go back to the president said repeatedly on the campaign trail, 10% tariff wall around the United States for everyone, 60% on China. That's almost where we might land.
What kind of damage is that going to do to this U.S. economy? Let's talk about this U.S. market. This bond market and the stock market still trading in lockstep. I think that's important to point out that, yes, this is a better tone, but still trading in lockstep. U.S. assets trading as one in the same bucket, and attitudes towards them trading as one at the moment. So, yes, we're whipsawing in one direction or the other, but we haven't fully restored what you'd expect to happen between bonds and stocks just yet. And I think that speaks to where we've been over the last several weeks. Your 30-year yield is down by 13 basis points. Your 10-year is down by 10 to about 4.30. Coming up this hour, we'll catch up with Scott Croner of Citi as stocks post their best day in 2 weeks, down Ives of Wedbush on Elon Musk's recommitment to Tesla, and Greg Dacko of EY on the risk of a tariff-induced recession. We begin this out with stocks higher as the president floats cutting levies on China. Scott Croner of Citi writing, we have expected that Trump administration policies would trigger first half of 2025 volatility, but miscalculated the impact. We have officially lowered our year-end S&P 500 base case to 5,800 from a previous 6,500. Scott joins us now for more. Scott, welcome to the program, sir. A lot of our thinking on all this predates the comments from the president just yesterday, so give me your thoughts, your update on your reaction to what we heard from the president in the Oval yesterday afternoon.
Of course, Jonathan, great to be on. So with our lower price target from last week, essentially we were still arguing that from that point to the end of the year, we're still looking at high single-digit return for the S&P. So even though we've lowered our target, color us constructive, the view very straightforward was that we've expected that we would begin to see more negotiation. President would begin to claim victory, even if they're small victories, and we'd see the maximum degree of uncertainty related to tariff and related policies come off the market, which had been, sort of in full swing since Liberation Day. So all told, we're getting directionally what we had expected to see. Now, what I would point out, to Anne-Marie's point earlier, that with that 5,800 target, we're using a 255 earnings per share for the S&P 500 at the index level, down from 270. In that number, we've been assuming a 10% across-the-board tariff with 60% on China. So gradually, what I would say is the president's narrative is coming down to actually where we're now projecting out our S&P 5 views for the balance of this year.
So, Scott, let's say we land there. Let's walk through the earnings assumptions. What are your assumptions about how much they can pass on to the end consumer, particularly the consumer-facing companies that you and the team cover?
Yeah, I think from the beginning, we've been talking about this for over a year now. Once Trump became, sort of the front runner on the Republican ticket a year ago, discussing that the tariff issue, in our view, would be more about margins than it is the traditional inflation concern. I understand where that comes from, but our perspective all along was that you instigate another level of tariffs, and what corporates try to do is extract some concession from suppliers, got that, try to pass through what they can to their end customer, run into price elasticity issues pretty quickly, and end up having to eat a lot of the tariff via margins, in gross margins in particular. It varies very clearly across sectors. So consumer discretionary is sort of ground zero in all of this. Tech, particularly in the hardware side, is going to feel the impact. But other sectors, it's going to be much more mitigated. You're not losing sleep over tariffs as a first order effect on areas like financials, real estate, utilities. Those become second order, third order. So the sooner you begin to appease some of the concern regarding tariffs, you begin to limit some of the broadening effect that tariff policies ultimately have.
Scott, if margins are the first ones to fall, potentially, what happens if the margins just get too tight? Do we then see layoffs at these corporations?
Yeah, so this is really interesting. We've talked about this. Historically, what happens is you have recession with said, triggers for that recession, and then earnings follow. This may be the first time, if you do go down the recession path, where we're actually led by a decline in earnings, not followed by a decline in earnings. What I'm getting at here is, again, what's the corporate response? You put tariffs on, you begin to feel the pressure around the margin and other operational elements. You look for productivity enhancements, you look for cost cutting. Potentially, you begin to consider layoffs that you hadn't considered previously. So what can happen here is a downward spiral effect. That's essentially how you get to the labor pressures that then constitute the recession risk. We're not there yet, but that's the path we've been on. I don't know that it's too late to pull out of that swoon, but we've been getting pretty close. So the news we're getting, yesterday and today, I think obviously is supportive of the stabilizing view, both on fundamentals and from an economic perspective.
Well, Scott, the first port of call, the first call is really corporate America reaching out to the White House. And we saw executives like Walmart actually going in for having meetings with the president. Do you think over the past week, everything you've seen, do you think that there are guardrails? There is this idea of a Trump put on policy when it comes to what corporate America is thinking and where the market's trading?
Yeah, we've been stepping back on the Trump put, Fed put. We've been focused more on corporate puts, which is essentially as prices come down for stocks, the free cash flow generation is still quite strong. you push out investment spend, and what you get is corporates essentially very aggressive buying back stock. But I think to your point on companies going to visit the Oval Office, essentially the issue here is that you've got a broad tariff policy, I get it, but what you're doing, and if you really think this through, is you're upsetting the basis for many companies' fundamental existence, if you will. Normally, when you think about efficient markets from a stock market perspective, it's yes, you're discounting earnings, but you're also assigning a terminal value to some end value of the company 10, 20 years down the road. You've thrown all that into a very unusual, precarious situation where you're not sure what it is that you're actually discounting. So what you do need here is better communication, like we're seeing right now, where companies are actually saying, hey, look, we see where you're trying to go with this. There are many roads to Rome on this, but the way you're going about it is that you're putting it's sort of a level of pressure and angst on not only the investment community, but the way corporates manage themselves that is sort of unprecedented and probably not as necessary as you think to get to the ultimate end goal of the policies.
Scott, let's build on some of this. The corporate put, I'm interested in that. How do you think they're going to manage the capital return programs in the months and years to come if they're uncertain about policy? What will that do to CapEx decisions, and what will it mean for ultimately capital return programs?
Right. So let's just put it real simple, Jonathan. So the way it's projected right now, we've per Q4 reports, we've got the S&P 500 projected to spend about $1.2 trillion on capital expenditures this year. Last year, the S&P 500 bought back about $900 billion of its own stock. Okay, now a lot of that is to offset stock-based compensation, but nevertheless, $900 billion. We've said, a few weeks back that $900 billion is another good starting point for this year, could easily be $1 trillion. Essentially, what the S&P 500 has been doing pretty steadily over the past several years is reduce its fully diluted shares outstanding by a percentage point or two every year. So essentially, what you have with the S&P 500 is an ongoing supply constraint that's coming via share repurchase. So what happens is that if you begin to dial back your expected capital expenditure and other investment spending because of the uncertainty, you begin to look at your investment alternatives, and as stock prices have come down, your stock becomes a viable alternative. So what we would expect to see here, should stock prices remain low and the tariff angst and uncertainty prevail, companies dial back investment spending, which is bad for future growth, by the way, but in the short term, what that ends up doing is freeing up a lot of excess cash that probably to some degree comes back to the share repurchase dynamics.
That is definitely not what the administration has in mind, that's for sure. Scott, appreciate your input this morning. Thank you, sir. Scott Cronert there of Citi. Equity futures on the S&P here higher by 2.3%. With an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackett. Say, Yahara.
Hi, John. President Trump said he never had any intention of firing Federal Reserve Chair Jay Powell. His comments coming just days after the president himself posted on social media that Powell's termination cannot come fast enough. And his National Economic Council director said Trump was exploring whether he had the authority to remove the Fed chair. Meanwhile, the standoff continues between the Trump administration and Harvard University over more than $2 billion in federal funding. The nation's oldest university sued this week to unlock the funds, saying the government made unconstitutional demands to overhaul its governance, hiring, and diversity programs. And Florida is suing Snap. The state alleges Snapchat markets to minors and includes features which are prohibited under a law targeting minor social media exposure. Snapchat issued a statement saying Florida's law both doesn't adequately address age verification and infringes on the First Amendment. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next, the morning calls, plus Dan Ives of Wedbush on Elon Musk's recommitment to Tesla. Tesla up this morning in the pre-market quite nicely. We're higher by close to 7%. From New York City, you're watching Bloomberg TV.
is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Better tone in Washington, better tone to the market. Equity futures up by 2.3% on the S&P. Queuing off what's happening in the bond market. Treasuries rallying. Yields down by 14 basis points. The 30-year, 474. 10's down 11 to 429. The president saying we're going to play nice with China. The president backing off from any kind of conversations about firing Chairman Powell.
Right, so these two issues that had a lot of consternation, angst in this market, the president taking his foot off that gas pedal. One, Jay Powell, I would just like you to take into consideration now might be a good time to have an interest rate cut. I had never thought I'd get rid of him, as the president talking, saying the press is running away with this. And then when it comes to China, really interesting, the president said 145, that is the ceiling when it comes to this tariff rate. It's not going to be zero, but it's going to be much less.
If you're bullish this market and bullish Tesla, yesterday afternoon you got everything you wanted to hear. Tesla higher this morning by 7% in the pre-market. Let's get you some morning calls and focus on that one stock. First up, CFRA downgrading the stock to hold, citing concerns about medium-term growth. Next up, Truist reiterating its hold on Tesla, saying it's keeping an open mind for future technical achievements. And finally, Canaccord cutting its price tag on a Tesla to 303, citing weak commentary around new models and macroeconomic headwinds. Let's stick with the name. Dan Ives of Wedbush raising his price target to 350, writing Musk recommitting as CEO and leaving his Doge role is the biggest and best possible news investors could have heard. Tesla got back its biggest asset, Musk. Dan Ives joins us now for more. Dan, good morning. Good to see you.
Great to be here.
Okay, so you're saying this is a recommitment. Other people would look at this and say, well, he's still going to be there 2 days a week, and that's a problem.
I mean, I view this was an off-ramp. I mean, however you want to sort of label it, 1 to 2 days, I think this is the beginning of the end. For him at Doge, with Trump White House, because that was a different Musk on the conference call. That was a different Musk than we've seen actually over the years. He addressed it head on, read the room, and we've talked about it. It was a fork in the road, a moment of truth.
Sure.
He took advantage of it, and I believe now it's a new chapter, and he leaves a dark chapter in the past.
Let's unpack the perceived problem of the last few months that you called a dark chapter. Some people believe, many in fact, that the president and Elon Musk relationship has damaged the brand. In the mind of liberals, want to be very clear about that point, and that's hurt the stock. Do you acknowledge that is what's happened over the past few months?
We've talked about it. I mean, it's the brand damage is real. It's been a dark cloud on Tesla stock. We've talked about anywhere from 10 to 20% because Tesla became a political symbol.
Why would that change if Elon Musk is still there 2 days a week?
Again, and I don't believe again, the 1 2 days a week, however you want to phrase it, my view is, and we've talked about on the show, this is the off-ramp to be like, okay, 1 2 days a week and I'm gone. I'm not saying that you're not going to see him at times with Trump, but we believe this is his taking a massive step back, recommitting to Tesla. And look, this was a different Musk on the conference call. This was not the normal Musk. This was one reading the room, aware of everything going on from a brand perspective. And I believe it's going to start a new chapter. Well, the brand damage is still going to be there. But I believe at least it will be contained. He doesn't double down. And this was an important time that I think would define the future of Tesla if Musk actually doubled down and do it.
But how does he fix the brand damage now? To Jonathan's point, 1 to 2 weeks in the White House, he's also still the self-proclaimed first buddy. He's still going to be out there advocating for the president.
I think that's going to be significantly diminished. I mean, I'd be surprised if we sit here 1, 2, 3 months and that's still happening. Even on social media, I mean, he's still going to, say what he wants, but I think even some of that will be diminished. Look, I don't know if it's the board if it's some of his confidants, but the reality is for Tesla, look, that's why this was a code red.
Is this a moment, though, for Tesla to realize that they actually need to brand themselves as Tesla, not as synonymous with Elon Musk?
I think that ship sailed. Because I think the reality is Musk is Tesla, Tesla is Musk. And so much of that has been a positive, despite maybe some criticism. The last 3 months, the reason it's been a dark chapter, not just because of the quarter, deliveries, but the brand damage and what ultimately Tesla became a political symbol. And I think it's a recognition that needs to end.
Where in the world do they need to do the most work to bring customers back?
Well, I think China, look, China's the hearts and lungs of the growth story. I mean, BYD has obviously been very strong, NIO and others. And I think China is where you really need to start to turn this around. The brand damage in Europe, I think a lot of that might be permanent. And we've talked about potentially 20%. US, maybe 10% brand damage. And my view is just that's still going to be there, but you had to contain it. You have to start in terms of autonomous robotics. And this was a moment.
So show me the growth. Where does it come from? And how soon does it come?
Well, I believe a huge part of the valuation is going to be autonomous and robotics. I mean, my view, like unsupervised FSD will start in Austin in June. When you look out over the coming years, I mean, I believe autonomous and robotics will be 90% of the valuation of the story over the coming years.
You spend a lot of time with the product. How good is it right now, full self-driving?
I mean, I think we're probably, let's call it 75% there to where you need to be.
And how much progress have we made? So we're at 75 to 80 now. Where were we, say, 12 months ago, 3 months ago?
I think we were probably, if I go back maybe a year ago, so we were probably 60%, 65. No, now technically you got to get to 99.999 to get there. But I believe they're making huge traction. And I think when we get to unsupervised FSD in Austin, it's a huge step to where the story needs to get to. And my whole point is, if this was an Intel, a Boeing, okay, so it's a disaster. It doesn't even matter in terms of, but for Tesla, it's my view, along with NVIDIA, two best disruptive technology companies in the world, that's what was so frustrating, why we were so loud, because you can't burn the house down now on this. You need to actually focus on the future. And I think that's why that was a different Musk on the conference call last night.
When do we get to the point where we see Elon Musk's realization of Americans really won't go out and be buying cars anymore?
Look, I think that's still much more of a longer term view. I mean, I think for
like a decade.
Look, I think that's something that you're going to have to go past to 2030 or, and I'm not a believer in that. I mean, I'm a believer autonomous is going to be a huge piece. Robotics is a huge piece, but that's much more, I think when you look longer term. But the reality now, it's about turning it around. It's about containing the brand damage. And it's about Musk. Leaders lead. This is the time to lead. And I think Musk took, for him, a huge step forward last night.
But it's not just Doge he's involved in. Neuralink, XAI. He is spread very thin. So why do you think all that attention is going to come rushing back to Tesla?
And that's who Musk is always going to be. But it's about the political damage that he did. Because ultimately, it became a political symbol for Trump administration, for Doge, and that can't happen. And I think I truly believe he underestimated the life of its own that this was ultimately going to become. And I think over the last few weeks, there was a recognition like, look, this cannot sustain going forward.
Are you overestimating the leadership it currently has in this sector? So this is the question that comes from a Bloomberg subscriber. Allow me to read it to you. BYD have introduced cars with double the range of Tesla and a 5-minute recharge. Tesla has the same car as 7 years ago, no innovation in their range and recharge. They're also ran in China. What would you say back to that?
I'd say let's talk in 6 months when we actually start to have, from an autonomous perspective, in terms of new vehicles that I believe are ultimately going to be out there, refreshes, and Musk and Tesla, how many times have been counted out? I mean, I could tell you in the last decade, or I could probably count on both hands.
I remember how many times BYD were counted out as well.
But I'm more I'm not negative on BYD. My view is just when you look at the opportunity for Tesla, it is going to be really about autonomous and the robotics future. And I think for Musk last night, this will be a moment in time, historically. He had a choice. He made the right choice, in my opinion, and I think now we start a new chapter. Still a lot of wood to chop ahead, challenges.
But BYD has something Tesla doesn't, which is easy access to the batteries. Yes. And China has 85% of the lithium. They have the processing to make these batteries and the raw materials. How challenging is that path forward for Tesla and other American EV makers? But
also, it goes back to Musk in terms of Beijing and in terms of everything we've seen with Giga in Shanghai. I mean, the point is, like, Tesla is, is cemented in China. It's not like they're just a U.S. car manufacturer trying to get into China. That's why, from a raw material, from production, from a vertically integrated perspective. But when you talk about the raw materials, and we've said it, like that comes down when we talk about tariffs and talk about everything. Where's the materials coming from? They're not coming from New Jersey. They're coming from China. And I think that's also why, like, a lot of things happen in the White House. Walls caving in, and you could talk fairy tale, reality, and that's why also Musk is anti-tariffs, speaks some of the issues.
He got all the bad things to be the first buddy, but not the good things.
He literally got all the bad things, like all the bad things, in a horror show, none of the good, and that's why we're here where we are.
It's certainly not the conversation we had with you back in November, December time.
It's a lot different than that Cinderella story that turned into basically a Nightmare on Elm Street, but now we take a new chapter.
Dan, we'll see if it's another fairy tale. It's good to see you. Dan Ives of Wedbush. Appreciate it. You like that? Yeah. All right. Coming up, Greg Daco of EY and David Rogel of BlackRock. From New York City, equity futures are positive on the S&P 500, positive by 2.3%. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the market?
not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The opening bell about 60 minutes away. Equity futures on the S&P 500 positive by 2.3%, so still close to session highs. On the Nasdaq 100 higher by 2.9. Let's get you some morning movers. So let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Here's one of the things helping the Nasdaq 100 outperform. We were just talking to Dan Ives of Wedbush about it. Tesla shares up 7%, and of course, Dan there really echoing some of the bullishness you're seeing in the stock despite some of the skepticism. And let's be honest, the not great quarter they had, the stock is trading on Elon Musk saying that he would spend more time at Tesla and away from Doge. So those shares up 7% this morning. Also joining in the big tech rally is Intel, up 5% in the pre-market trade. A great Bloomberg scoop from the tech team that Intel is set to cut about 20% of its workforce. It's going to announce those plans at some point this week. It's all a plan from the new CEO to remove some of the layers of the bureaucracy in the company and switch to what people familiar call a more engineer-driven company. Finally, rounding things out with some earnings. About an hour ago, we got Boeing earnings. The cash burn was a lot less than expected, about $1 billion less for their free cash flow loss. So those shares up nearly 5%. Kelly Ortberg calling 2025 the year of our turnaround, saying that they'd get their cash cow out there, that 737 MAX jet. One important thing to keep in mind, though, with all of their projections for the year, they use the assumption of what tariffs look like on March 31st. Of course, so much has changed since then, but just really shows how companies are struggling to understand exactly what type of environment they'll be operating in. John.
Danny, thank you. Thanks for this morning. 3 names to watch going into the opening bell about 60 minutes from now. Going into another busy day of Fed speak ahead as President Trump dials back his attacks on Fed Chair Jay Powell. Mike McKee, our economics and policy correspondent, joins us now for more. Mike, I imagine they'll feel a little bit more comfortable today than maybe they would have yesterday morning.
I suspect that is true, John, just because the distraction is going to be gone. Obviously, for Jay Powell, it's pressure off his shoulders, but for the others on the board particularly, they don't have to worry about what are we going to do if we end up in court over this. Now the question is, what does Donald Trump do if he's not going to fire Jay Powell? He has some alternatives. Obviously, Powell's term is up as chairman in May of next year, so he could just wait and appoint somebody else. The question is, Powell's term as a governor runs till 2028. Will he do as previous chairs have and just resign from the Fed entirely once his term is up? His other alternative is Anita Kugler is rolling off the board in January of 2026. Does that mean that Trump could appoint a chair in waiting? That has some downsides to it as to who people listen to, but it may be his only chance to put someone on the board that he could elevate. The third choice would be to elevate Chris Waller, who will be on the board till 2030. He's already there, so he could become chair at any time. Hopefully that doesn't happen now until May of 2026.
Mike, you've seen a few of these. So last time around, the administration was grappling with what was happening with inflation, a whole bunch of things coming out of the pandemic, and they left it really, really late to reappoint Chairman Powell. Typically, what kind of time frame do you have in mind to get these things done and sorted out?
Well, on a normal Washington kind of timeline, you'd want to have somebody nominated by January in order to get them confirmed by maybe the end of March or April so they could take over when the chair leaves. But at this point, it's hard to know exactly what they're going to do because we may have this Kugler situation where the president wants to get ahead of that and so actually would name somebody in November or December for confirmation as soon as possible. And then that person certainly becomes the focus for the financial media and for people on Wall Street. What are they saying they're going to do once they're in office? So it is a complicated situation that should have some more clouds on the horizon for the markets.
Mike McKee, thank you, sir. Appreciate it. Mike McKee down in Washington, D.C. More from Mike in just a moment. I think this is the problem now, because they've talked openly about this in the past, this shadow Fed chair, that whoever is nominated, whoever's interviewed, they'll be treated as just that in the months to come.
Exactly. Another genie let out of the bottle that already everyone knows. The second there's a name and even reporting of who's the top individual when these interviews take place in the fall, everyone's going to be laser focused on everything that individual has said in the past and potentially anything they say going forward before Powell's term is up.
Here's the take from Greg Dacker of EY, expecting the Fed to remain on hold at its meeting next month, writing the Fed will likely remain reactionary to data with a hold until June, potentially 3 back-to-back cuts in the second half of the year. Greg joins us now for more. Greg, good morning. Good to see you.
Good morning.
The FOMC, with the exception of Governor Waller, have been pretty consistent about putting some weight on anchoring inflation expectations. Would you expect that to stay the same for the next several months?
I think in the short term, yes. The Fed is going to want to be very careful, very reactionary to economic data. Fed Chair Powell and other Fed policymakers have mentioned that they're satisfied with where the FOMC is, and they're ready to wait for more clarity as to the economic effect of these tariff policies. They don't want to front run or preempt any type of policy in this highly uncertain environment. I think the key issue here is the uncertainty with regards to Fed independence, given all the pressure that we've seen and what Mike just mentioned with regards to the risk as to Fed independence. We are talking about a confidence crisis right now, but the real risk is a trust crisis, because a confidence crisis is something that is short-lived in time. It can go away, it can come back, but the trust in the Fed's independence and the Fed credibility is something that can have lingering effects way past any administration and can put into question the Fed's desire and ability to actually monitor inflation risks and address them as necessary.
Fed officials can manage the optics of that, and I imagine if they're thinking about that a little bit too much, does that raise the threshold to do anything? Does that make them dig in?
I think that's potentially a risk, because we have right now an economy that is still robust if you look at the hard data. If anything, hard data has been quite strong because private sector actors have been trying to front run the tariffs. So we are in this environment where consumer spending surged in March because people were trying to front run the price increases from tariffs in terms of automotive goods and other types of goods. We're seeing business orders rise as a result of trying to front run these tariffs. We're seeing imports surge as an effort to try to front run these tariffs. So the economy is good. Inflation risks are to the upside, and we have this political pressure against which many policymakers, including Fed Chair Powell, are trying to push back against. That could push them to essentially adopt a stance that is more restrictive than would otherwise have been the case, to avoid this impression of any type of political pressure influencing their decision.
And the more they dig in, potentially the more jawboning we're going to get from the President of the United States. How dangerous is this cycle?
I think the cycle is very dangerous. We are in this environment where there are really 4 key channels of transmission of all of the policy uncertainty that we're seeing. The first one is the confidence crisis that we're seeing. We're seeing all sorts of private sector soft data plunge. That is a key risk for the economy, because if it feeds into actual spending, that's a key damage to the economy. Number 2, market volatility. It's not just about the cyclical market volatility, but it's about this bigger question as to whether there is a regime shift away from dollar-denominated assets. Number 3 is the fact that we're going to see the hit on prices and on volumes, and that will deter economic activity. And number 4 is this key question of policy inertia. Does the Fed stay put and risk having excessively restrictive monetary policy in an environment where it should potentially accommodate some of the tariff hit and demand destruction?
Are you calling for a preemptive cut?
I'm calling for preemptive inflation anxiety for a few months now, and we're starting to see that. We're seeing consumers front run the tariffs. That's putting pressure on supply chains at a time where they're already stressed. We're seeing businesses do the same, and we're seeing a desire from businesses to pass on higher costs very rapidly. So essentially, we're in this environment where we could see inflation take a turn for the worst over the next few months. And I would anticipate that there is going to be more demand destruction than in the past, which should allow for the Fed to ease monetary policy, not as much as it would have done in a traditional demand shock, but in the context of this unusual and uncertain supply shock, it could provide some accommodation in the back end of 2025.
You can have some confidence that that's the outcome based on just a brief assessment, a general basic assessment of how tight the labour market is right now.
Yeah.
And maybe they could sit here and say it's not as tight as it was, so the likelihood of second-round effects are lower than they otherwise would be. I'd want to know from you how much data they need to have the confidence that really is the case. Is June too soon? Do you need to wait until the end of summer to sit here and say, okay, I'm convinced now, I've got a firm degree of confidence that I'm not going to see those second-round effects, we can cut rates?
I think they will wait at least until June. They may wait a little bit longer. We know that the Fed is extremely, and in my opinion, excessively reactive to economic data. The economic data is always present with a bit of a lag, and that means that they're likely to wait longer than would normally have been the case in order to assess the need and the desire to essentially ease monetary policy in the face of what is potentially a recessionary shock on the economy from these tariffs. I think one thing that's very important to assume is what you're anticipating in terms of tariffs. We're not anticipating right now that the current tariff rate, the average tariff rate, is going to remain as it is today forever. We're actually expecting in the second and third quarter of this year a dial back of China tariff to 54%, and in the fourth quarter to 40%. That is our baseline assumption. That is an environment in which we have GDP growth only at 1.1% this year and 0.2% by the fourth quarter.
Basically what you've said all morning.
Everyone's tying themselves in knots to understand where the baseline is, and you hit exactly what the president has been saying for months on the campaign trail. 10% for everyone else, 60%, you're very close, 54% on China.
And this is why we still can't figure out what's going to happen with the economy. Greg, it's a good time to catch up with you.
Thank
you, sir. Thank you. Greg Zacco of EY. We've got some Treasury supply coming up a little bit later, and it's coming at a decent time for the Treasury because there's a bond market rally taking place at the moment. The 30-year yield is down by 14 basis points. 10s are down by 11. Some 5-year supply coming a little bit later. With a look at that, let's get to Mike McKee for more. Hey, Mike.
John, we got about $70 billion of 5 years going on sale today. The question is, how many of those are going to be bought by people overseas? The markets and the Treasury Department are looking for indications that overseas buyers are getting tired of what's going on here and may pull back. The issue is we watch indirect bidders to see if there is a significant percentage from foreigners. Yesterday's 2-year auction, which tailed by 6 basis points, not a good result. The indirect award fell to 56.2%, lowest in 2 years. So will the same be true of 5s? Because 2s and 5s are the favorites of people overseas. If they're not wanting them, if they're not enthusiastic, that's not good news for the Treasury. Right now, though, we are looking at a when issued rate just below 4%. That would be the lowest in quite some time. So it would be good news for the Treasury if they can sell these with a little bit of a concession, but not too much.
Certainly a better day for it. Mike, appreciate it. Thank you, sir. More from Mike McKee through the Down Bloomberg TV and on Bloomberg Radio, live from Washington, D.C. today. With us around the table here in New York, jumping in, David Rogel of BlackRock. David, good to see you, sir.
Good to see you. How are you?
Bonds are still trading like stocks. So I'm still a little bit nervous about that. I think other people might be as well. Maybe you're more confident today, given the soothing words of the president, and yields are lower, but still that correlation holds with equities. When does that start to break in a different direction?
Yeah, it's a great question. I mean, I think what we've seen in the last few weeks is a huge pickup in bond market volatility, particularly in the long end. And that really stems from, I think, fears around foreign demand, more recently fears around Fed independence. And the real scare factor came from that few-day period where bond yields rose about 40, 50 basis points. The stock market was doing poorly, and bonds really weren't hedging stocks at all. And so I think people are very concerned about that diversification element. When you take a step back and you look year to date, most intermediate bond funds are up around 1.5% on the year, and the stock market's down about 10, 12%. So while you haven't gotten the same hedging value that you're used to in bonds, it has been a relatively okay place to hang out, a point of relative stability in the market relative to more volatile assets. And I think when you look at these factors like foreign demand, potential Fed issues around Fed independence, to us that supports this idea of higher term premium. And ultimately, I think it's an opportunity for the domestic investor. We've talked about how the supply-demand imbalance in treasuries is tougher these days. You have more price-sensitive demand, and you have more supply with deficits, et cetera. So I think what it is an opportunity for the household. We think the intermediate bond sector, in an active intermediate bond fund, you can pick up 2 points of income relative to cash. We think it's a good opportunity for the household to pick up yield. We think it's a good investment opportunity. So while we're a little bit concerned about the increase in volatility, we're not concerned about the asset class.
It's the international investors' treatment of U.S. assets that interests me. And at the moment, they're not discriminating between asset classes. They're just seeing dollar-denominated assets in one bucket and treating them all the same. Is there any reason that's going to change anytime soon?
I think it's an absolutely reasonable concern, but I think it's interesting to note that foreign demand, at least in the treasury market, has been declining for a number of years. And so this is a fact. If you look at the foreign official sector, their ownership of treasuries peaked in the mid-2000s around 40%. And that's steadily come down to around 13, 14%. So I think it is definitely a major concern in terms of how we're going to fund our deficits. We have potentially significant budget deficits to fund over the next few years. But it has been a trend that has been in place for a number of years. And I think ultimately it comes down to the household to pick up the slack.
Do you think when these trade negotiations get more underway with places like China, we could see buyer strike out of Beijing?
It's very possible. I think there's kind of two elements to this. Over time, if we actually are successful in reducing our trade deficits, that's going to result in less inflows into U.S. domestic assets as kind of the accounting identity. Question of whether or not foreigners will kind of weaponize treasury sales against us. You know, there's a lot of speculation about this. We haven't seen, it's very hard to validate that in the flows. We've actually seen some pullback from domestic investors in anticipation of potential pullback in foreign demand, but we haven't necessarily seen the pullback in foreign demand yet. But I think it's a real concern, and another reason why we have to be very cautious about how we evolve these trade policies. As a reserve asset, we don't want to be doing anything to jeopardize reserves, the U.S. dollar reserve status.
Everyone we ask that says there is this question about reserve assets, of the dollar, treasuries, dollar-denominated assets, they don't know who's going to fill that void. Do you have any idea?
I think it comes down, I mean, we'll have to see how the budget policy evolves and whether or not we're successful around reducing deficits. I think that's going to be very difficult over time. But again, I think it comes back to the household. I think the household's going to have to absorb the majority of supply. And, you know, I think we're seeing some green shoots potentially from the banking sector. We had in 2023 a lot of concern about banks being able to absorb duration. I think with the potential loosening of some of the regulatory policy and the improvement in bank balance sheets, you will see banks absorb, and you should see some, you know, some demand come through in the pension community as well. So I think the capacity is there to absorb the supply domestically. It's just that it's a more price-sensitive buyer.
What happens with the American love affair with equities with that in mind?
Yeah, it's a really tough question. I mean, I think at the end of the day, we have a dynamic economy. We have one of the most innovative economies in the world, and I think coming into this episode with tariffs in April, the economy, like the prior guest was saying, was actually in very good shape. We're actually in a Goldilocks economy. I do worry about foreign demand. If you look at the weightings in U.S. equities and in global indices, they're at all-time highs. So I think it's a concern, but I'm optimistic in the longer term about the U.S. economy and the U.S. capital markets.
We appreciate that optimism this morning. Thank you, sir. Thanks for dropping by. Thank you, David Roger there of BlackRock. Things doing better this morning, up by 2.5% on the S&P. Talked a lot about that rally in the bond market and the fact that the bond market and the stock market are trading in lockstep. You don't see that big bounce in the U.S. dollar, though, this morning. Euro dollar is only slightly negative, and maybe that's the one to watch throughout today. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. President Trump said he plans to be, quote, very nice to China in any trade talks. Trump said the 145% duties he placed on the country will be dropped if the two countries can reach a deal. China has been intensifying its outreach to other countries in recent weeks, warning them not to strike trade deals with the U.S. that hurt Beijing's interests. Meanwhile, Intel shares are rising 5.6% in the pre-market. The company is expected to announce plans to cut more than 20% of its staff this week. A source says the move is part of a bid by the new CEO to streamline management, eliminate bureaucracy, and rebuild an engineering-driven culture at the struggling chip maker. Meanwhile, tech giants Apple and Meta have been fined nearly $800 million by the European Union for violating antitrust rules under the EU Digital Markets Act, with Apple taking the brunt of the punishment. The fines are far lower than previous penalties and are seen as an attempt to avoid provoking a harsh response from President Trump. Those shares are up in the pre-market, though. That's Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Your opening bell is about 42 minutes away. Up next on the program, we'll set you up for the trading day ahead and get a final word from Tyler Kendall from Washington, D.C. From New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The opening about 38 minutes away. Equity futures near session highs, up by 2.6% on the S&P. On the Nasdaq 100, up by more than 3%. As we count you down to that opening bell, let's get to the calendar. The trading diary looks like this. At 9:45 Eastern Time, we've got some PMI data. After that, 15 minutes later, don't miss this, the Treasury Secretary, Scott Bessent, speaking at the IIF in Washington, D.C. That's one to watch later this morning. Then at 1 p.m. Eastern Time, a better day for a 5-year Treasury auction. That drops later on this afternoon. Looking ahead to tomorrow, durable goods and another round of jobless claims, plus Alphabet earnings after the closing bell. Then going into the weekend, the final read of UMich consumer sentiment. Joining us now from the nation's capital, from Washington, D.C., Tyler Kendall. Tyler, certainly in a very different place this morning versus where we were 24 hours ago.
Yeah, hey, John, definitely, particularly when it comes to this administration's tone. But we'll have to see how long that tone will last. And we could get some answers today when the Treasury Secretary does take the stage at 10 a.m. Eastern at the IIF. Of course, that's happening alongside the IMF spring meetings here in Washington. And as you've been discussing all morning, the IMF managing director telling Lisa that she feels this week could be a good one for China and the U.S. to engage in a dialogue while at the forum. We have to really keep in mind here that our reporting does indicate that the Treasury Secretary previously has indicated that he thinks that there could be positive momentum when it comes to a potential trade deal with China, though has cautioned it could take 2 to 3 years longer for a finalized agreement. And John, I would just quickly mention that these are going to be Bessent's first public comments since the IMF spring meetings have started here in Washington, and we'll be watching closely the tone, because I think it's fair to say that since the Trump administration has taken office, they haven't necessarily engaged with the IMF and the World Bank, often abstaining from internal votes, and they've yet to appoint a permanent executive director to either organization. And President Trump has often made known his public disdain for multilateral organizations. So that tone here today is going to be very important as the White House contends they are speaking with 35 different nations to try to negotiate trade deals.
Tyler, appreciate the update. Tyler Kendall, thank you. It's an important moment for negotiations. We've had some encouraging signs on the likes of India, on Japan, also on the likes of China overnight, at least from one side of that negotiation. Now we want details. What is the ask? What do they want from these nations?
It's going to be interesting to see what the blueprint is that gets offered in these 90 days. That's what it looks like is going to happen. India, Japan, there'll be a blueprint that will come out because trade deals take minimum months, most likely years to get done. A blueprint will offer up a path for everyone else that doesn't get in this handful of deals done very quickly. That's a key question. What are the asks besides tariff-to-tariff barriers, these non-trade barriers? How difficult is it going to be to do things like VAT tax, transnational shipping? Then it comes back, of course, to China. and what the ask is there and where we land on between 0 and 145%.
And whether Chinese officials are even engaging. Now, notably absent in this little conversation, Europe. Where are the Europeans? What is the status of those talks?
Well, the status right now, according to the central bank governor of Germany, is that they are here for negotiations. But it's very complicated because right now it doesn't look like the U.S. is prioritizing Europe. They are looking to India, to Japan. Korea is in town to have negotiations. When it comes to the European Union, they've just been talks, but nothing substantial.
The Bundesbank president telling Lisa earlier on this morning that we could see recession in Germany and that economy could well stagnate in 2025. We'll see how much worse it gets. We'll head down to Washington to catch up with Lisa again tomorrow morning. Coming up tomorrow, live from Washington, D.C., we'll catch up with the Eurogroup president, Pascal Donohoe, the ECB chief economist, Philip Lane, Franklin Templeton CEO, Jenny Johnson, and the Standard Chartered chair, Jose Vinales. From New York City this morning, good morning.
Live daily on Tennis Channel.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Another big day of gains, 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a relief rally. Stocks rise as President Trump diffuses some tensions over Fed Chair Powell and China trade talks.
Meanwhile, Elon Musk is ready to shift gears, so to speak. He vows to step back from his White House role, easing investor concerns at Tesla.
And troubling signs as more earnings continue to roll in. CEOs haven't been this pessimistic since the financial crisis. All that and more coming up, but let's take a look at stocks under the hood, and we have to start with Tesla, absolutely flying right now. That's after Elon Musk said that he's going to pull back from Doge and focus on the struggling car maker. That's good enough to send the stock nearly 8% higher, Matt.
We'll talk about those struggles. Boeing revenue met analyst estimates as it slowly ramps up production of 737 jets again. The company also burned less cash than previously had been expected.
I've got another story we're watching in the middle of a lot of change. Intel plans to announce more than 20% in job cuts this week in an effort to streamline management. Intel reports earnings tomorrow, and the stock is up pre-market. Katie.
Meanwhile, zooming out, markets breathing a sigh of relief yesterday after President Trump softened his tone on Fed Chair Powell and on China.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. I think we'll make a deal with China. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high.
Let's get the latest from Bloomberg's Tyler Kendall in Washington, D.C. So, Tyler, the president says he wants to play nice after slapping China with 145% tariffs. Is he backing down?
Yeah, hey, Matt. Well, President Trump does appear to be softening his tone, but there's two big questions here. One, is it enough to get Beijing to the negotiating table? Because up to this point, demanding that Xi Jinping call him directly doesn't necessarily seem to be working. And the second question is, how long will this tone last? Because the White House has made very clear that they need to see a significant rebalancing of trade when it comes to Beijing, and tariffs aren't going to go down to zero. And our reporting indicates that officials still plan to pursue asking our trading partners to curb their own trade with China. Now, the White House press secretary yesterday did say that they were, quote, setting the stage for a deal with Beijing, but fell short of saying that any of those negotiations have actually started. We did hear from China's Commerce Ministry earlier this morning, who said that the door was wide open to talks with the U.S., but at the same time, Bloomberg News had reported last week that there are some important preconditions Beijing has asked for, including that a point person other than President Trump lead the negotiation. There has been some signs of optimism, particularly after yesterday Bloomberg News reported that Treasury Secretary Scott Bessent told a closed-door meeting of investors here in Washington that he's optimistic that tensions could end up cooling with China, and that a trade deal is doable but could likely take 2 to 3 years.
Well, we'll hear from the Treasury Secretary out in public at 10 a.m. today. Looking forward to that. But Tyler, before we let you go, let's quickly talk about the other reason why you have the S&P 500 up 2.6% pre-market right now, and that has to do with what Trump said about Jerome Powell, saying that he has no intention to fire the Fed chair. That's different from what we heard from Kevin Hassett just last week, saying that he was looking at options.
Right, exactly. And Bloomberg News reporting earlier this week that President Trump did ask his advisors in private whether or not it was possible to remove Powell amid mounting legal questions about the legality of firing independent federal regulators. And President Trump yesterday really saying that the market reaction has been overblown. He never had any intention of firing Powell, but at the same time still suggesting that the Fed chair could be behind the curve, saying that he would like to see Powell early rather than late. But as you guys well know, analysts have been saying that this is a really difficult position for Powell. Mark Zandi of Moody Analytics was just on Bloomberg Television saying that the Fed chair's job has never been tougher because the central bank is stuck between a rock and a hard place when it comes to inflation and weaker growth.
Bloomberg's Tyler Kendall, we appreciate your reporting. We're going to get more from you later. Now, on the earnings front, Tesla surging today despite missing estimates and pausing 2025 guidance until next quarter. Elon Musk said he will refocus on Tesla after months at the Department of Government Efficiency.
Starting probably in next month, May, my time allocation to Doge will drop significantly. I'll have to continue doing it for, I think, probably the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
Craig Trudell, Bloomberg's global car czar, joins us now. Now, Doge had big ambitions. I don't understand why now he's so ready to step back. Is there any skepticism around his repivoting to Tesla? You know, you don't really see it that much in the stock this morning.
Yeah, I do think we're seeing a pretty substantial, jump in the shares, but we should keep in mind too that this is a highly volatile stock that's really gotten beaten up, for months now, and I think there's perfectly reasonable questions to ask here about just how much we can sort of take Musk at his word that he's going to substantially step back when he himself is saying 1 or 2 days a week for the rest of the administration. Whenever Trump needs him, he's going to be there. And so this notion that this is going to sort of put to rest, the concerns about any damage he may be doing to the brand and the extent to which he's turning off customers or would-be customers for Tesla, it seems that a lot of those questions are going to take some sort of sorting out in the months to come, depending on just how substantial he sort of takes a back seat here, if you will.
Craig, it's difficult for me to understand why anyone cares if Tesla's car sales drop, because investors aren't paying $700 billion for a car maker here, right? This is a totally different story. Is it a robot maker? Is it a software company, an AI play? What is it?
I think it's kind of all of the above. And to your point, this is a company valued in a way that we don't see any other car maker, and valued as a sort of combination of many of the world's biggest car makers and most valuable manufacturers. And so, yes, they need to deliver on these robotaxi predictions that we've heard Musk make year after year. They likely need to also stand up a humanoid robot business. I think one of the more interesting comments during last night's call was this idea that the trade war with China is potentially setting them back in terms of being able to produce humanoid robots because of the restrictions that China has placed on rare earth metals and the ability for the company to get its hands on magnets for those robots. And so Musk talking about trying to work with China to resolve that. And I think it was interesting that he didn't mince words about tariffs and sort of how he differs from the president while still deferring to him to call the shots in this regard.
All right, Craig Trudell, really appreciate your reporting, talking about Tesla up almost 8% pre-market. To check on the sell side, you had Wedbush raise their price target on Tesla, but you had RBC, Cantor, Canaccord, Baird, Roth Capital all lower their price targets. So let's keep that sell side conversation going now with Ron Yevsikov. He is Guggenheim's senior analyst. He has a sell rating on Tesla. Ron, it's great to have you with us. It was actually a pretty dismal first quarter for Tesla. You wouldn't know it by looking at the stock this morning because there's all this enthusiasm about Elon Musk refocusing on Tesla next month. You're sticking by your sell rating. Tell us why.
Yeah, candidly, I don't think a lot actually changed last night. I appreciate the shift on Doge being a potential positive for the story, but really we got a reiteration of timelines that we had last quarter. I think the number one driving force for the reaction this morning is the bar was quite low coming into this quarter. Expectations had come down quite a bit. There was risk related to the affordable models, which were reiterated. But overall, just sticking with the June timeline where there is quite a bit of skepticism of Tesla delivering on the robotaxi launch in June. That's enough to lift shares tonight, and certainly kind of trade commentary has been helpful overnight as well in terms of potentially softening of the rhetoric with China. But yeah, results are quite dismal. I think this year this is probably a cash burning business based on our estimates, and I'm not sure related to the vehicle business what we can have confidence gets better even next year at this point, because it continues to deteriorate.
Speaking exactly of that, if you're thinking about the cash burn, you had them trim their spending plans. And even with the CapEx expenditures anticipated to be lower now, what does that mean to you? Does this mean that the caution is warranted, or does it mean that the growth rate is not going to be what investors have been factoring in?
Yeah, it's kind of tough to parse the CapEx cut, because I think a large portion of it relates to kind of the ability to source capital equipment that may have a source of origin from China or some other region where there's currently reciprocal tariffs. So it's tough to parse how much of this is actually a negative shift in terms of the outlook for growth versus kind of a supply-driven shock that will ultimately impact growth, but it's not necessarily Tesla's view on the world changing as much as the trade policy of the world changing kind of dramatically over the last month.
Ron, we kind of joke about Optimus, the humanoid robot, a little bit, but how important is that to the future revenue stream? I mean, I thought it was interesting he said robo-taxis are going to be meaningful to the bottom line in June of next year, so that's not far off. What about robots?
Yeah, robots are tougher for us to underwrite. I think given we haven't seen really a primary use case for the product yet, to the extent it's labor replacement, I think people would be surprised that vehicle manufacturing is not terribly labor intense today. It's not insignificant, but it is around 10% of kind of costs within vehicle manufacturing. I think ultimately most investors are far more willing to underwrite robo-taxis, and that is kind of what's implied in shares. I think robots, to the extent Tesla can deliver on their promises, would be positive optionality versus the current share price.
Yeah, the robots are hard for me too. I just know I want them to stay far away from me. But Ron, I want to talk quickly about Tesla's energy business, because Musk has made the case that when it comes to the car business, they're pretty isolated from the trade tensions. But you think about the company's megapack energy storage systems, for example, relying heavily on China. Musk has pointed to this area too as a potential growth region for the business. What do you make of that?
Yeah, I think certainly it will impact the cost of the business this year. The way tariffs are implemented for the vehicle business, they're pretty well insulated. For the energy business, battery sourcing does come from China. LFP batteries are reliant on China for sourcing. I think that it's probably not a tremendous risk to the top line of the energy segment this year, because they do have quite a bit of backlog and they should be able to pass on some of those costs. It probably does compress margins if we're sitting here in the back half of this year and reciprocal tariffs on China remain in place. But I do think that the bigger risk is if we continue to get supply shocks and they just can't deliver on the growth and the capacity that they put in place.
Guggenheim's Ron Yevsikov. Very sorry there, Ron. We are working on it for you. Katie, taking a look at futures here, because I know we are looking at another comeback story.
Yeah, huge day today. It's all about Trump, it's all about Tesla, and it's all about Fed Chair Jerome Powell, of course. Musk softening when it comes to Doge, Trump softening when it comes to China and to the Fed chair. You can see that expressed in futures right now. The S&P 500 up 2.4% after a 2.5% rally just yesterday.
I will say, I hope we can get deeper into it, because there's so much more going on in this market, right? Especially since you see investors buying treasuries, they're buying Bitcoin, but they're shunning the dollar.
Yeah, a lot of different cross currents to explore there. Also cross currents when it comes to the earnings front. We had Boeing this morning.
Yeah, absolutely. Boeing improving its cash burn while stabilizing its production line. We're going to have more on that earnings report next for you. This is Open Interest.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
In case you missed it, on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you, if it's grown, like we've invested in PBR and professional bull riding, that league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up, if you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. A forest fire is raging in southern New Jersey. Although evacuation orders have been lifted and a section of the Garden State Parkway that was shut due to the blazes now reopened, the fire rapidly grew to 8,500 acres in Ocean County, about 90 miles south of New York City. Satellite imagery shows the fire was inching closer to the Oyster Creek nuclear power plant. The facility was closed in 2018. It is now being decommissioned until we need it for artificial intelligence. Apple and Meta were fined nearly $800 million by the European Union for violating new antitrust rules. The penalties were imposed under the EU's Digital Markets Act, which was mainly aimed at Silicon Valley giants like those two. The punishments are far lower, though, than previous penalties under traditional EU law and may be seen as an attempt to avoid provoking President Trump, who had warned of harsh retaliation. And Goldman Sachs shareholders are set to vote in just a few minutes, or at least the AGM kicks off in just a few minutes, on whether to approve $160 million in special bonuses for CEO David Solomon and President John Waldron. The bonus packages are Goldman's way of keeping talent and warding off competition. That's what they say, but the size of the payout has drawn criticism from activists. Two shareholder advisory firms, Glass Lewis and International Shareholder Services, have both pressed investors to reject those pay packages, and they'll vote later on after they do a whole bunch of other ceremonial stuff at the AGM. Katie?
Yeah, we'll keep an eye on that, but we're also keeping an eye on Boeing shares on the rise in the pre-market after the embattled plane maker reported results that beat Wall Street's expectations on revenue. That's as it ramps up its jet production. For more, I'm thrilled to say we're joined by Tony Bancroft. He is portfolio manager over at Gabelli Funds. Tony oversees the Gabelli Aerospace and Defense ETF. He's also a former FA-18 Hornet fighter pilot with the U.S. Marine Corps. So, Tony, you are uniquely qualified here. Let's start with what we just heard from Kelly Ortberg speaking on Arrival Network, saying that the bigger issue on tariffs is supply chain health and that China has stopped taking delivery of its aircraft. I know that there's a lot of enthusiasm right now over the shrinking cash drain that was reported, the plans to ramp up output. But as an investor in this company, how are you thinking through some of the trade risks here?
Yeah, Katie, great to be back. I think, in the near term, Boeing, Boeing was just very fortunate to build up inventory, over the last couple of years, which people thought may have been a bad idea. Now it looks like a really good idea. So I think they're pretty well protected. There was a comment that the other day Boeing made that they're able to find other suppliers for the SPS fire. And, they're going to be able to probably get through this with production, even if there is some supply chain disruptions. But in the long term, you heard CEO Ortberg say this again and again, that this could be an issue. It's a global supply chain. A lot of it, of course, is domestic, but you got to have every part of the plane in order to for it to be allowed to fly. So they're going to have to deal with that over the long term. But with these retaliatory tariffs, these planes don't, they need a lot of maintenance, right? There's constantly servicing the engines, and these components are going to have to be, an aircraft is essentially a razor blade business, so it needs to be serviced. And I think, I don't know if China and getting into this retaliatory, trade war is going to, for the aerospace industry, is going to do, 60% of their fleet is 50-60% of their fleet is Boeing aircraft. So they're going to need to, get these parts eventually.
Significant risks, but also you have Kelly Ortberg calling this a turnaround year. To the extent that they're starting to make progress on that, what is the next phase of that turnaround that investors are going to need to see?
Yeah, they're going to have to see the FAA authorize them to go above 38 a month. That's sort of the big ticket item. And they sound pretty confident in that. So I assume that they've been working closely with the FAA, and they're talking about getting to 42 a month, this year. So I think that's probably what investors are sort of looking to next. This Thoma Bravo sale is a boon for them for their balance sheet, improving that. And then the F-47 win that for the next air dominance fighter is a huge win for the defense business. And you're seeing that business in the commercial business stabilizing. So some good things going on.
Hey, I wonder what you think about military spending overall, Tony. I mean, are we going to be cutting our defense spending or at least holding it stable as we look to reduce government spending in general?
I think it's probably a little bit misunderstood, I think, by the general market that you've heard you've heard comments talking about cutting the military spending in half. If China and Russia were to, I think all things being equal, that's just not realistic, and I think it's probably more rhetoric. But I think the reality is that you've heard the SecDef talk about readiness and lethality and getting back to that. And I think the spend's actually going to go there. And you've heard about the $1 trillion defense budget. And the reality is that the defense spending is directly correlated to global volatility, geopolitical volatility and stability, which we're seeing probably at a peak right now, one of the peaks. So I think long term you're going to see continued defense spending in the U.S. and, by the way, Europe and all of our global allies are all talked about increasing defense spending.
Well, Boeing shares currently up about 6.5% pre-market. Tony, great to get some time with you. That is Tony Bancroft of Gabelli Funds. And he mentioned that deal, of course, for the Jeppesen unit. Later this hour, we'll speak with Holden Spate, Thoma Bravo managing partner, about the firm's acquisition of Boeing's flight navigation unit. This is Open Interest.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, And if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Welcome back to Open Interest. We are 5 minutes away from the opening bell. You can see that we have a relief rally on our hands. The S&P 500 up 2.6%. A lot of those gains coming from big tech, coming from Tesla, with the NASDAQ 100 up about 3% right now. Sonali, what I'm interested to see is what volume looks like today, because we know that trading volume has been pretty light this week.
Pretty light, but at least on a percentage terms, we're seeing a big enough move. Some more movers on our radar, because a lot moving under the surface as well. AT&T subscribers beat after Verizon's miss. You're looking at the stock still down less than 1%, more than 1% right now. Philip Morris, though, still up about 4% pre-market. They boosted their EPS forecast, calling of their cigar business for sale as well.
Calling it off.
Calling it off. Thank you for that. So no M&A there. India considers zero tariffs on Harley-Davidson bikes. Your hogs are up.
I mean, how many people in India are buying Harley-Davidson motorcycles?
You know, have you driven in India before?
I have not been to India.
Very scary roads.
Well, I think I would like to do it on a hog. All right, less than 4 minutes until the opening bell. We begin the trading day with Corient's Amy Kong.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We We are moments away from another big rally on Wall Street. This is Bloomberg Open Interest. I'm Matt Miller. You're looking at a 2.5% gain in futures after a 2.5% gain in the cash trade yesterday. So we could be building on that rally as it looks like the Trump administration is backing off a little bit of the aggressiveness of its trade war. NASDAQ futures up even more than 3%. So tech stocks getting a bigger gain. Of course, they got hit harder. Shenali always shows us how the Mag 7 have been doing year to date, and they're still all down year to date. Opening bell at the New York Stock Exchange. Couple ETF operators here. The New York Stock Exchange, you've got Elm Victor Agani, co-founder of Long-Term Capital Management, there with his ETF that's just started trading, I guess, in February. And then you've got Rex ringing the opening bell. BMAX is one of the ETFs that we're focused in on, or that Rex is focused in on today at the NASDAQ. BMAX is, I think, a convertible bonds ETF that is all about Bitcoin. And Katie, Bitcoin has been very interesting because it continues to rise even as the market is in turmoil.
You know, Matt, I was going to say, you sound like someone who used to anchor an ETF show, really dusting off your knowledge there. And a crypto show, that's true. A long, illustrious resume for Matt Miller. But let's talk about what's going on with Tesla, because it's still flying this morning after Elon Musk's comment he's going to pull back from Doge and refocus on the struggling car maker. Shares currently up about 6% just on that news, Janelle, even though the first quarter was pretty dismal.
Not struggling today, though, and not struggling over here either. Boeing's revenue met analyst estimates as it slowly ramps up production of 737 jets. The company also burned less cash than expected. Shares up now almost 7%, Matt.
All right, and Intel is another one that's gaining today. On its own news, as well as, you know, with the rising tide, Intel announcing plans to cut 20% of its jobs. The hits keep coming for people who work at this one-time behemoth. 22,000 jobs are going to go at Intel as the new CEO looks to streamline management and get back to an engineering culture. Intel reports earnings tomorrow, so we'll see if it can continue with these kind of gains. Let's discuss with Bloomberg Technologies' Ed Ludlow. He joins us out in San Francisco. So, Ed, you know, they just cut, what, 15,000 workers last year. Another 20,000 and change are going to go now under the new CEO. Is this really helping the company?
I still think there's a sense that Intel's bloated, right? And what our reporting and the source says is that this effort, this latest one, the 20%, is focused on middle management. So it's a bloat issue, but also a cultural issue. You know, Pat Gelsinger's kind of legacy was that he was ultra focused on Intel becoming a contract manufacturer for third parties. And the product side of things wasn't really ever recovered. It doesn't really seem that Intel's at the cutting edge and competitive on key markets like AI accelerators. So that's the motivation here. Yeah, kind of cut overall headcount beyond the 15,000 they did last year, another 20%, but kind of get a lean and mean vibe going in Intel where they focus on the technology as well.
Well, yeah, just for context, you think about Intel, apparently it had just under 110,000 employees at the end of 2024, so still some bloat there. But tell us more about what we should be expecting to hear when they actually take the earnings stage tomorrow. It seems like Wall Street says that the worst of the revenue declines are behind this company, but it's not like they're going to return to maybe some past decades growth levels.
Yeah, I mean, you know, the story on Intel is that they kind of missed the boat on GPUs, right, or AI accelerators for data centers, and they were heavily at that time in August when they did the last round of layoffs leveraged towards CPUs. You know, they were offering loads of something that people didn't want as much of. It'll be interesting to see if they've rebalanced. And then on paper, like Intel is the national champion for the United States, right? On paper. It's the biggest beneficiary on paper of the CHIPS Act, which is so uncertain. So it'll be interesting to hear from them how they feel about accessing funds from the CHIPS Act and whether that they can basically put their hand up and say to the administration, help us. We want to do what you're talking about, onshore more supply chain here in the United States. And I think that they will kind of lean into that a little bit.
Ed, I have been waiting all morning for your take on this show on Tesla. Tell us what you got.
Yeah, you know, markets and investors don't seem so focused on sales and profit, right? And I think that we got exactly what the market hoped for, which is Elon Musk just to say the simple thing, pulling back from Doge starting next month, May, and re-emphasizing a commitment to Tesla, a lot of it doesn't add up. I mean, there is a 130-day limit anyway on a special government employee, even if they're not paid. So he would have had to have stopped working with Doge in some capacity by the end of May anyway, based on that 130 days. There are some contradictions in the earnings deck, what Elon Musk said and what the CFO said. If you take your magnifying glass, you can find them. Elon Musk said basically outside of macro issues, there's no impact to demand. The CFO contradicted that and said quite clearly there was the vandalism and brand issue, which hurt demand, changing political landscape, quote from the deck, impacting demand going forward. But on the biggest exposure in the whole tariffs thing, it's definitely China and that energy storage business, where we need to learn a lot more about the proportion of cells that are coming out of the Shanghai facility that go into energy storage products here in America.
Plus, they're going to start producing the cheaper car this half. They're going to do full self-driving, not just Europe and Asia, but in America this year. So there's some really good up-arrow stories there as well. Ed Ludlow, look forward to your program at 11 a.m., Bloomberg Technology. Let's broaden out to today's market rally. We're joined by Corient partner and wealth advisor Amy Kong here in the studio. Thanks so much for joining us on set, Amy. Thanks. What do you think about yesterday? We got a flurry of headlines out of Scott Bessent at a JP Morgan meeting, and then Donald Trump. He's going to play nice. He's going to essentially back down a bit on this trade war with China. Does that make you more bullish this market as well?
Not quite there yet, but I certainly welcome some of these relief rallies. And essentially, just pulling back a little bit, the market is and has been trading on headlines, and it probably will continue to do so over the foreseeable future, just trying to gain some clarity on what to make of the tariff war situation. The good news is we are entering into an earnings season right now, and the hope is that the market focus, if you would shift a little bit more towards fundamentals. But as we saw with Tesla, I think the markets are still very keen on trying to find those macro clues and trying to look for clarity. We do think fundamentals will kick in. We are starting to see estimates come down a little bit, and that's important. But I do think the market is still very market-driven.
Well, that's where I wanted to go, that if we do return to that focus on fundamentals as we get into the heart of earnings season, as you mentioned, earnings estimates have been coming down. The ratio of downgrades relative to upgrades, it's been negative for weeks here. So maybe we focus on fundamentals, but it seems like we're going to get some bad news in the weeks ahead.
It's possible that the earnings estimates will continue to come down, Katie, and we started to see that already. I believe that the market was expecting maybe around 14–15% year-over-year growth, but that's likely to simmer down. It's already down to about 10 to 11%, and we're only 20% in terms of S&P 500 earnings. Don't forget the Mag 7 companies have not yet reported, and that's slated to happen later this week into the coming weeks as well, and that certainly could be, again, a trigger in terms of those earnings estimates coming down a little bit more.
You know, Amy, when I looked at the sectors this morning after the open, you are looking at consumer discretionary really helping lead this rebound. And one thing I think is interesting is if you click through, you would expect it to be so much of Tesla in that, but you see like Williams-Sonoma and other stocks kind of helping lead the way here too. I think that's fascinating because it shows you people have been really, really, really negative on the U.S. consumer. You even saw some of that negativity float from the staples into the discretionary sector too, or the other way around rather.
Williams-Sonoma is not cheap.
No, not cheap.
Me and Sonali both like to cook, so.
A little too much. But you know, how much do you have conviction in those consumer trades at this point in time, given so much concern around consumer sentiment?
Yeah, absolutely. I think, you know, to your point, the idea could be that consumers are front-loading, not waiting to purchase and doing that now in case the price hikes steepen a little bit more towards the back end of this year. What's interesting is that, you know, the headlines out there are scary. And, you know, what we are seeing is that that kind of scariness is not yet translating just yet into the data points. Retail sales, to your comments just before, you know, have not been suggesting any kind of recessionary signal just yet. And so there could be, you know, the fact that household balance sheets are still healthy and consumers are still spending, or some of the front loading, as I just mentioned.
So do you think the Fed is going to be able to cut? Do you think the Fed should cut now? We don't see inflation coming back in the hard data, as you point out, and we do see growth slowing down a bit. So why not cut?
You know, as long as the Fed's independence is still in the picture, you know, for as long as they can hold on to that, I think the Fed is still looking for a trend line in terms of the data flow. And the CPI numbers have not been getting worse, but they also have not been moving closer and closer to that 2% target. So as long as they can hold out, I would think that the Fed would want to wait again as far as they can, maybe June, maybe, you know, a little bit in the summertime before their first cut.
May 7th to the next meeting.
That's correct.
I do want to bring us some breaking news here. This coming from the Wall Street Journal, saying that China tariffs likely coming down to between 50 and 65%. That is certainly a lot lower than 145%. Trump hasn't made a final decision on China tariff cuts, though, according to the Wall Street Journal. But again, that 50 to 65% threshold certainly giving an added pop to the S&P 500 right now, currently higher by about 2.8%.
You got to wonder if that's just the reciprocal or if it includes the 20% fentanyl tariff.
Hopefully we'll hear more from Treasury Secretary Scott Bessent on this topic at 10 a.m. But Amy, you just told us not to overreact to headlines, but they are coming hot and heavy when it comes to trade policy, especially. And with that in mind, I mean, as an investor, how do you calibrate? Because, okay, there's a lot of headlines, don't overreact, but it does seem like the world order is shifting a little bit.
No, absolutely. And, you know, the headlines, especially towards the earlier part of this month, have been just very wild as we all know it. We have been advising clients not to trade into that noise, but certainly we are looking for some of this momentum. You know, we have this 90-day pause. We're hopeful that trade deals can come through, or at least some initial momentum there. And ultimately, what we're telling clients, what I've been telling clients, is to stay humble in this context, understand that volatility is a feature, not a bug of the stock market. And within the stock component, I do think that having exposure to companies that have the scale and the ability to manage through tariffs, pricing power, you name it, expense control, those are, you know, in our opinion, the better way to manage through this chaos. And we certainly do understand that headlines can turn to the negative, as we've seen, but to your point, you know, some of this momentum can actually be on the upside.
Yeah, it looks like the market is staying humble as well, and S&P 500 initially reacting to that news, but cooling off a little bit just off of session highs. Corient partner and wealth advisor Amy Kong, we thank you so much for joining us here on set. Now coming up, Thoma Bravo buying Boeing's flight navigation unit for over $10 billion in cash. Thoma Bravo managing partner Holden Spate joins us next for today's Wall Street Beat. This is Open Interest.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stradwatts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back to Open Interest. Let's take a look at this rally right now. You have the S&P 500 higher by 3%. We just had that Wall Street Journal reporting that we're looking at lowering China tariff levels. That's, again, according to the Wall Street Journal, that's good enough for session highs on the S&P 500. The NASDAQ 100 also off to the races right now, higher by about 3.7%. And you have the small caps getting in on this action, up about 3.9%. We do have some breaking data, though, when it comes to this market, you guys.
And this is kind of a pro-Trump data set here in terms of the S&P Global U.S. PMIs. We have better than expected PMI for manufacturing, and it's even expanding. So over 50 on the manufacturing PMI, 50.7 the level there. We were looking for a contraction at just under 50, 49. The services missed, but also expanding. 51.4 was the services PMI. We were looking for 52.6. But I think it's interesting that you get that kind of trade-off, right? A little bit of expansion in manufacturing, Shanali, and you still have expansion in services, but not quite as much as we expected.
Right, but the manufacturing is the point, as you say, for the Trump administration. The S&P gains really elevating off the heels of that news, and also an interesting contrast from Europe, where similar data was disappointing. So back to that Invest in America trade, the one we haven't really seen for days. Katie.
Good enough to keep that rally going on the broader indexes. Let's focus in now on top calls, though. Some of the analyst action in focus this morning. And first up, automotive technology company Mobileye getting upgraded over at BNP. The firm says that gross margins are significantly higher versus its peers because it doesn't make any of its own chips. Next up, we have SolarEdge getting cut to a sell over at Morgan Stanley. The firm citing worsening demand and a negative impact from tariffs and the company's exposure to changes in the Inflation Reduction Act. And finally, Chevron getting downgraded to equal weight over at Barclays. The firm citing expectations of lower oil prices. And this downgrade, it's Chevron's second of the day after Redburn cut the stock to sell, Shanali.
And it's time now for the Wall Street Beat. Today we are looking at Thoma Bravo's purchase of Boeing's flight navigation unit for nearly $11 billion. Joining us now, Holden Spate, Thoma Bravo managing partner. Holden, I've got to say, you've kind of blown me away by your deal making so far this year. You're stepping in at scale at a time when many people are not. And when you think about this deal in particular, what were the details in terms of how you won it and what Boeing was able to put up to make this deal attractive to you?
Perfect. Well, thanks so much, Shanali. It's great to be on your show again, and especially with such an important transaction announcement. And look, this is exactly the type of business that we look for at Thoma Bravo. This is a market-leading business. Their data and navigational charts really power the commercial and business aviation industry. They're a market leader. It's 90+% recurring revenue. It's 95+% renewal rates. You have very happy customers. It's a double-digit growing business that's very profitable. So this is a very, very, very special asset. Because of that, it also attracted a lot of interest from both the financial buyer community and the strategic buyer community. And I think really what Boeing was looking for really was certainty of closing, speed to signing, and a value that worked for its shareholders. And I think fortunately we were able to provide all three. We developed a great relationship with Boeing. There's still a lot of work to be done to transition this company out of Boeing. But this is a very important company. It's a very important transaction. We developed a great relationship with Boeing, and we're very fortunate that we're able to announce such a big transaction in a time that's relatively volatile.
Well, talk us through how this is going to work going forward, because my understanding is that you agreed to allow Boeing to retain some rights to the data that is generated by these products. There was some reporting that that potentially was a deal killer when it comes to other potential sales here. How is that arrangement going to work going forward?
Yeah, no, this business, Jeppesen, and we spent a lot of time on this, obviously, but it owns all the IP that it's owned historically. Now, Boeing has some internal use. They have some rights to use some of that, but Boeing is not interesting, nor are they really able to compete with us with our own product set. It's very important anytime you do a carve-out to ensure that the business is allowed to get all the IP that it is, and that was a point, obviously, that we needed to, and others needed to negotiate. But to do a deal of this size and magnitude, we have all the relevant the relevant IP that we need to run the business to continue to operate in the way that it's been run.
We were talking with Tony Bancroft at Gabelli, and I said, "Hey, man, we got Holden Spate of Thoma Bravo on later. What would you ask him?" He said, "Well, I'd really like to know what the margins are in that business." Is that something you're able to share?
I don't know that it's been shared publicly, so maybe I'll just say that, I think, look, we have a very special operating playbook when it comes to data and software companies. This company does run at really nice margins already. Boeing has done a really nice job of getting the margins to a spot where they're good. Now, we think with our operating playbook, we can both enhance the growth rate of the business and improve the margin profile over time, which is very consistent with all the other, large enterprise software transactions that we've done. But the margins are healthy operating margins today.
What are your plans for Jeppesen? Are you combining all of these digital assets into a single entity under the Jeppesen brand? You did get other offerings here like Oz Runways, and is the plan to eventually take this public, and what margins will they have then?
Well, I think, look, the great news here with a company like this that's so special, where it did attract so much interest, just like most of our companies, we buy very high quality revenue businesses, and we use our operating playbook, and we have done it for over 2 decades to really enhance both growth and the profit margins of the company. We operate internally, we operate a lot of companies. You hear Rule of 40 in the public markets, which is a combination of revenue growth and profit margins. We operate a lot of our companies at Rule of 50 plus, even Rule of 60 plus, and you've seen some of the deals we've sold, like Adenza, Ellie Mae, Frontline. These are all companies that are growing double digits at 50% margins when we sold them. And we think this company has exactly that kind of potential. We're going to carve it out, operate it standalone, and I think in the end, when we're done with our work and we have a great partnership and working on a great business plan, it will be attractive to, just like it was in this time, it will be attractive to the financial buyers, strategic buyers, and the IPO markets, which are frankly very interested now in profitable growth, which is exactly the kind of product that we build at Thoma Bravo.
All right, well, we're looking forward to watching how this business transforms under your ownership. Our thanks to Holden Spate of Thoma Bravo. Meanwhile, quick check on the S&P 500, soaring right now, up about 3%, hit session highs of 3.4% just a couple minutes ago. Volume off the charts. We'll bring you all the action next. This is Open Interest.
like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what's going on with stocks absolutely soaring after that Wall Street Journal story. Okay, we've come off a bit at 285, up 2.9% really, but volume is still huge. NASDAQ up 3.4%. A ton of stock stories, no news on NVIDIA, but Tesla, obviously after the earnings, Boeing beat on earnings as well. AT&T taking all of Verizon's customers, and Harley-Davidson going tariff-free in India. I want to get back to you, Katie, because the Wall Street Journal headlines really pumped up this market.
Yeah, just a flurry of news coming from the Wall Street Journal, Shonali. When it comes to tariffs, those levels likely coming down. This one's interesting, too. Trump chose not to fire Powell on Bessent and Lutnick concerns.
Very shocking. The two market men are telling the president behind the scenes, according to the Wall Street Journal, to stand back on those Powell threats and the Fed independence, but also really the market moving on those tariff headlines. This idea that they can cut some of these tariffs by more than half. That and some economic data putting this market on a tear.
Yeah, absolutely. Coming up in the next hour, the man himself, Treasury Secretary Scott Bessent, is set to give a keynote at the IIF Global Outlook Forum in Washington. We'll bring it to you live.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
Markets rally, jumping at the open after President Trump softened his stance on Fed Chair Jerome Powell and steep tariffs on Chinese products. Dow's up 1,000. CBS's Kelly O'Grady with investors.
I think that the sentiment that they're trying to convey is that deals are coming. And of course, we saw the markets react very positively. But I went and I spoke to a number of investors. And I said, well, what do you think? And by and large, I heard, okay, this is great. There's some optimism, but there was also skepticism because the negotiations have not started.
At the Vatican, the faithful inside St. Peter's Basilica now, filing past Pope Francis' coffin to say a final goodbye after his remains were transferred from his Santa Marta residence this morning. John McKay traveled from Hazel Grove, England.
They taught us all how to be Christians and to be human, and that's what we are so happy about. So we'll follow him. And we want Pope Francis II now.
Crews are making progress containing a massive wildfire near the Jersey Shore. CBS News Philadelphia's Ross DiMattei says about 3,000 people forced from their homes have been allowed to return.
As far as the fire itself, this thing was a monster. Yesterday, it pushed all the way up against the Parkway, and this is a major highway, so they actually had to shut it down for hours overnight. That, too, though, has since reopened.
A spring break tragedy in Panama City, Florida. Police say 3 high school seniors from Concord, Massachusetts, including a 2-time state diving champion, were killed when their SUV collided with a tractor-trailer making a U-turn. A 4th student's fighting for her life. Police in L.A. say they've arrested a man captured on surveillance video committing arborcide. CBS's Michael Wallace.
Police say the suspect used a chainsaw late Friday night. There's no word on a motive. Residents found the toppled trees on their sidewalks the next morning.
I don't know why someone would take away from the trees, especially in downtown where there's not a lot of opportunity for trees to grow.
Local arborist Stephanie Kerry.
It takes seconds with a chainsaw to erase decades of potential environmental benefit. So that is just extremely tragic.
Happy birthday, you two.
All right, so here we are, one of the elephants.
The first video was uploaded 20 years ago today of the founders at the San Diego Zoo. Tech contributor Ian Scher.
YouTube is a cultural force unlike almost anything else. It has reach that is far larger than most of us can ever really imagine.
The Nasdaq's up 4%. This is CBS News. Students, parents, and fellow teachers in Central Florida are trying to help a fired teacher get her job back.
Brevard County Public Schools fired Melissa Calhoun for calling a student by their preferred gender identity name rather than by a birth name. State law says parents have to approve, and they didn't. Superintendent Mark Rendell.
We can't really choose which state laws we're going to follow and which ones we're not.
But most of those attending the latest school board meeting called the firing an overreaction. Teacher Christine Stanek.
There was no harm, no threat to safety, no malicious intent, just a teacher trying to connect with a student.
Peter King, CBS News, Orlando.
A poll from the Kaiser Family Foundation today finds Americans aren't sure what the truth is about the measles vaccine. As cases continue to rise across the country, the survey finds misconceptions abound over a link between the MMR vaccine and autism, that the vaccine's more dangerous than the measles, and that vitamin A can prevent infections. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Podcast Live. That's where you'll find us. Alex Steele is out today and tomorrow. She's somewhere in the oil patch, Texas, Oklahoma, I don't know, but doing her oil and gas and energy stuff, reporting. So she'll be back at the end of the week. Isabel Lee sitting in for Alex. Thank you, Isabel, for hanging out for the next couple hours.
Thank you. I'm excited.
You're
Lots
bringing
of
us
headlines.
a good tape. You're bringing us a good tape here. The
Hopefully.
stocks are up a snapback rally again today. Coming up, we're going to check in with Katerina Sareva, Bloomberg Federal Reserve reporter, to get what we're going to hear from Treasury Secretary Bessent, because around 10:15, we're going to take the Q&A. Treasury Secretary Scott Bessent participates in a Q&A with the Institute of International Finance President and CEO Tim Adams. We'll bring the Q&A live to you to see kind of where we're going here with some of these economic policy. Stuart Paul, U.S. economist with the Bloomberg Economics, he's going to join us, give us his thoughts on Secretary Bessent's comments as well. Craig Trudell, Bloomberg Global Autos, he's going to recap Tesla's earnings. The numbers were ugly, but I think the big news is Mr. Elon Musk is going to be coming back to Tesla in a more hands-on way going forward. So that's positive, I think, for that company and that stock, and that's one of the reasons the stock is higher today. So we got a lot coming up in the next couple of hours. Let's kick it all off with John Tucker and a Bloomberg Business Flash.
All right, guys, this flash being brought to you by IBKR. Will U.S. initial jobless claims exceed 260,000 for the week ending May 10th, 2025? Yes was recently at 8%. Trade your prediction with IBKR Forecast Trader at ibkr.com/forecast. Last trading day for this contract, May 14th. Let's start off with the data. New home sales, a lot better than expected, up 7.4% for March. The expectation was only for 1.3%. Right now, the S&P 500, 3% higher, up 162 points. The Dow up 1,047 points. The NASDAQ 100 up 655 points. Risk on after President Trump backed off his threats against Fed Chair Jay Powell and indicated he may be backing down from his tough stance on China. Tesla, as you said, Paul, among the most active, walking back from earlier guidance for vehicle sales, but Elon Musk is back. Meantime, Rianne Mitrione at Callan Family Office says investors are eager to seize on any good news.
The market seems to be looking for a reason to rebound. I mean, we've had, sentiment is at such a low level that any news we're getting that is better than a worst case scenario is really leading to a nice bounce in the market.
And Intel cutting 20% of its workforce. That's about 22,000 people. The firings being announced this week. 2-year yield right now up 3 basis points, 382. The 10-year down 10 basis points. That is at 429. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Isabel and Paul.
All right, John, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we are streaming on YouTube as well. The markets are ripping. As John was just reported, the S&P up 3%. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Lisa Mateo. Lisa, what are you looking at?
All right, so we got to start with Tesla, right? Because you said it. The numbers were not good. The company missed on both revenue and earnings. In fact, the worst quarter in years. Results showed weakness in automotive business, tariff trouble and expanding energy business. But the thing is that Elon Musk told investors what they wanted to hear. He said he's going to pull back from his role in Doge in May significantly and focus more on Tesla, which is what they wanted. He said his work establishing the group is, quote, mostly done. And it's created this tension, right? You've seen a lot of the protests that are going on. They've sprung up in recent months against his government work. And Tesla have been struggling, right? Slumping sales, rising costs from the trade war. But he tried to reassure investors. And this is something interesting he said. He said, at Tesla, we've gone through many a crisis over the years. This is not one of those times. And because of all this, he said, the shares have been up more, as much as 6% since after the open.
What about Boeing? I feel like this company just can't catch a break. Are they showing signs of stability?
Yes. Yeah, their shares up as much as 6% since the open. First quarter results, good news, topped estimates, smaller than expected adjusted loss per share. Here's the thing, too. It used $2.3 billion in free cash. The 3 months ended March 31st, ramped up jet production. So you know about the 737 MAX jetliner. Well, they want to raise output to 38 jets per month and then try and increase that to 42 units later this year. And that would really help generate the cash that's been used up by different things, right? The recent strike, manufacturing crisis, too. Kelly Ortberg said 2025 is their turnaround year.
I am flying a 737 MAX jet Saturday morning down there
you go.
Durham, North Carolina. So I'll do my part there. But I mean, they need to get that production up. And you know, I quote George Ferguson at Bloomberg Intelligence. He says they're on the right track, but ideally they need to be in the 50 plane range in terms of monthly production. So they're getting there. So I guess that's right. And the cash burn, that free cash flow, negative free cash flow came in better than expected for the quarter. So that's, I guess, some good news for that stock. Another, just blue chip back in the day stock, AT&T.
Yeah, and there's, a lot of competition, right? You have Verizon, you have T-Mobile, so a lot of competition. So they did share some good news. They attracted more new wireless subscribers than expected, 324,000 mobile phone customers. The first 3 months of the year, it's highly competitive. It comes after Verizon. You remember yesterday they reported a loss of subscribers. And the thing is, consumers, they're a little bit more price conscious, right? We're holding on to our phones a little bit longer. They've rolled out fresh promotions. You've probably seen a lot of the promotions lately. Also, a beat on revenue for AT&T grew to $30.6 billion. It also reiterated its 2025 full-year guidance. But we continue with this, guys, because you have T-Mobile that's following up tomorrow.
I mean, all right, I'm a Verizon Wireless. You're
Yes, I'm
AT&T. John, what's your wireless carrier?
I have no idea.
What? How do
It's the one you get with AARP.
Oh, my gosh.
I'm kidding. I don't know. No,
Isabel?
it's
I'm guilty. I grabbed my
Verizon,
phone.
yes.
I'm
There we
Verizon
go.
too. I used to be T-Mobile.
Oh, interesting. Well, Tom Keene is
Tom's
T-Mobile.
T,
So it just
yeah.
shows that's the competitive aspect of the wireless business.
Yeah, and it goes. It's very diverse. But yes, I will go with my AT&T. It's just we never change it. I don't know
Yes,
why.
I'm in Verizon because I'm in a family plan with friends, and the friend just decided to move. So I'm agnostic. I'm like, you go wherever you want. I just want to keep my number. That's an important thing.
All right, you know how I kicked all my offspring out? They're off the dole.
Wow.
They get nothing except
the family plan.
yes. And I could take it even one step further, but I won't. But
No.
Anyway, there's a lot of people on my family plan there. All right, Lisa Mateo, thank you so much.
join?
Yeah, exactly. Everybody
Sign
else
me
is.
up.
I mean, it's crazy. Lisa Mateo, she has 7 jobs here at Bloomberg, and one of them is doing the stocks report. So for more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or wherever you get your podcasts. So there we go. Isabel, big move in the market today, following up on yesterday.
Definitely. And I feel like the big headline now is White House considers slashing China tariffs to de-escalate trade war. That's according to Wall Street Journal. And a lot of the notes I've read this morning was about that. They were like, why is this aggressive stance fading quickly? The comments came without getting anything in return from China. And some were also alluding that maybe Trump is indeed listening to some moderate voices in his camp, like Secretary Scott Bessent and even Howard Lutnick. And look, we have agreements with Japan and India looking promising, but China's far more complicated.
Yep, and it's interesting. We had Chris Crescente on from MAI Advisors in our studio just earlier this morning. He says he's not buying the dips. He likes to see this positive rhetoric on tariffs and so on, but there's still that level of uncertainty that you just don't know. I mean, the tweet could come out in the next hour reversing all of this.
Absolutely.
And so that level of uncertainty keeps him from kind of stepping in and trying to, I guess, buy the dip.
We do have Michael Kantrowitz of Piper Sandler saying that this is a market that's largely driven by macro forces, and we just have to expect large swings.
All right, let's get back to what we're hearing on the economic front. Again, we're going to be having U.S. Treasury Secretary Scott Bessent. He'll be participating in a Q&A at the Institute of International Finance. We're going to bring those Q&A to you in just moments, but let's get a little bit of a preview here with Katerina Sarajeva, Bloomberg Federal Reserve reporter. Katerina, what do you expect to hear from our Secretary of Treasury?
Yeah, I think it should be interesting to hear. We've heard some comments today from the Trump administration just on the China tariffs that they are, walking back kind of some of the more extreme tariffs that we've seen being imposed. Trump saying that he's willing to negotiate. So I wonder if we'll hear the same from the Treasury Secretary. We've kind of heard those types of comments from him before, so I wouldn't be surprised about that.
What do you make of the JP Morgan comment? Because that got a lot of attention. But for instance, we have Neil Dutta of Renaissance Macro saying that this isn't new. Scott Bessent has been saying this for a while.
I'm sorry, I'm not sure which comment you're referring to.
The JP Morgan comment when he said that reciprocal tariffs announced on Liberation Day were a cap, which would go down.
Yeah, I mean, I feel like we've just seen in general a lot of back and forth with the tariffs, right? I think at first everyone kind of thought that they would be used as a negotiating tactic, and then, and then we kind of saw the sweeping nature of them, and that kind of spooked everyone. But we've certainly seen them walk back a lot of what was initially announced on Liberation Day. So I wouldn't be surprised to see a bit more of that. And I think that the China comments are kind of in line with that sort of sentiment.
Katerina, we've seen some reporting, and we've talked to some guests here in the studio here that have said, you know what, even if you do walk back the tariffs to a meaningful amount, some damage has already been done, whether it's supply chains being disrupted, whether it's orders being delayed or canceled, that you could see, some empty shelves or some thinned out shelves, and the consumers already is likely to feel this, even if the tariffs are walked back. What do your sources say?
Yeah, I mean, I think that's true. We have already seen an impact on the business community, right? Investment has already been pulled back. Plans have been pulled back. I think you're right. There have been effects on the supply chain as well already. I think any pulling back in tariffs would for sure be a positive in terms of what we could see for businesses and for growth later in the year, but there is already an impact in place. And not for nothing, I think we've already seen some businesses suffer and some small businesses shutter because of them.
How unprecedented is the walking back of Trump when he says he's going to fire Powell? I feel like this isn't new. He's said this a lot, but recently it's becoming more aggressive. And then he walked back and markets were relieved. How relieved are your sources?
Yeah, I think quite relieved. I think any talk around that is nerve-wracking for markets, but also kind of on a larger level, right? Central bank independence in developed countries has been the standard for decades. And it's really scary, both from a day-to-day volatility perspective, but also just from an economic perspective. It's really scary because there's a lot of research out there showing that an independent central bank leads over time to lower inflation, to better economic outcomes. So it's something that really concerns everyone, from markets to economists.
So, Katerina, what's the view of kind of where we go from here in terms of tariffs and economics? Is it just up to President Trump? Is there some time period where you think you might get maybe at least some concrete policy one way or the other?
Yeah, I mean, so we're in this 90-day reprieve right now. So I think everyone is kind of waiting to see what happens in this time. We're seeing some news of negotiations trickle out. You know, the comments, again, about China, I think kind of help give people a little bit of indication of where things might be going. But it is still very much a wait-and-see mode of what happens with all these different countries and where the rates really end up. I think most people expect there to be some sort of tariff, whether it's this 10% across the board or slightly higher rates for some trade partners. So that's kind of a known right now, but I think that otherwise it's very much uncertain right now and very much kind of everyone looking to the White House to see where this ultimately lands.
To Paul's point, the U.S. is probably suffering a lot of reputational damage with this back and forth. Trust has been faded. What are your international investors or sources telling you? Are they trying to move away from the U.S. when it comes to investing, or are they waiting in the sidelines? What is the sense you're getting?
Yeah, I think you're seeing a little bit of that, right? We've seen that in the asset moves for sure, with folks moving out of treasuries, out of the dollar, out of U.S. stocks, kind of all at the same time. So that's definitely an indication of a little bit less appetite for U.S. assets. But I don't think you're seeing it too widespread yet. And I think we're still in a place where some of that could be reversed, just depending on what happens. But yeah, I think this has really kind of jolted this global order that we were all accustomed to, again, over the past many decades. And we're seeing a bit of a shift right now. How widespread and how long lasting that shift is, I think really depends on how these tariff policies ultimately play out.
All right, Katerina, thank you so much. We really appreciate it. Katerina Sarajeva, she is a Federal Reserve reporter for Bloomberg News. She's down in Houston, Texas, and she is a graduate of the University of North Carolina at Chapel Hill. Despite that, she's an excellent reporter, and we appreciate getting a few minutes of her time. And again, we are waiting for U.S. Treasury Secretary Scott Bessent. He's participating in a Q&A with the Institute of International Finance, and we'll bring that Q&A to you when it starts in just moments. But in the meantime, let's get a little bit of a reset here. We'll go to John Tucker for any Bloomberg Business Flash.
All right, the major stock indexes, they are surging off the best levels of the session. The risk-on move fueled by the idea, the president taking a less controversial stance toward China in the trade war, as well as the fact that Mr. Trump backed away from threats to try to fire the Fed chair, Jerome Powell. Business activity expanding at the slowest pace since 2023. Output expectations, they've deteriorated, and price pressures mounting as tariffs created headaches for companies. These are the findings of the S&P Global Flash April Composite Index. The output at manufacturers and service providers dropping 2.3 points to 51.2. S&P 500, 139 points higher right now. That's up 2.7%. We're at 54.28 on the index. The Dow Jones Industrial Average up 880 points. And the NASDAQ 100 right now up 598 points. That is a rise of 3.2%. We have 10 of the 11 major industry groups in the S&P 500. They are higher, being led by consumer discretionary. And that is home to shares of Tesla. Those shares up 5.6% since Elon Musk coming back to the company. Boeing reporting first quarter results exceeding Wall Street estimates. Smaller than expected adjusted loss per share of 49 cents. And right now, Boeing is up 5.6%. Rite Aid running low on cash. They're preparing to sell themselves in pieces as they head toward their second bankruptcy. Rite Aid is among a slew of retail companies struggled the past couple of years as consumers cut back on spending because of the high rate of inflation. Two-year yields right now, 381. That's up 2 basis points. Then you have the 10-year down 8 basis points, and that is at 431 right now. Oh, here's one for you, and I'm not going to embarrass you.
Okay.
The Stanley Hotel in Estes Park, Colorado, planning to borrow nearly $300 million to fund a major renovation and expansion. This includes a new event center dedicated to horror. Stephen King and his wife stayed at this hotel way back when, in the early 70s. They were the only guests because the hotel was preparing to close for the winter the next day. And that was the basis for his book.
The Shining.
The Shining in the movie.
I thought that was based upon something in upstate New York, you know.
No. The
Okay.
hotel out there. Beautiful hotel,
Okay.
by the way.
Awesome.
That's a cool story.
Yep, very good. All right, John Tucker, thank you so much.
Isabel,
We appreciate
do you
that.
know The Shining? Have you seen The Shining? Have you read the book?
No,
Okay.
but it sounds interesting.
Oh,
and I'm interested.
John.
Oh, red rum?
No.
Okay, never mind. We won't go into it. Anyway, that is your Bloomberg Business Flash and more. Back to you guys.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. Right now, let's head to U.S. Treasury Secretary Scott Bessent. He's participating in Q&A with Institute of International Finance President and CEO Tim Adams. Let's listen in right now.
Institution like the IMF World Bank, I must say there's a collective sigh of relief across this town right now, because the concern coming into this week is that you were going to do exactly what you said you're not going to do, which is the U.S. would withdraw, but you want to lead. What you're asking for is simply getting back to factory settings, right? Focused approach, and deal with the issues that you see are most paramount, correct?
Correct. As I said in my confirmation hearings, I think U.S. engagement with the international financial and multilateral institutions, we should engage, and we should be in it to win it for the American people and for the rest of the countries and for the client countries.
20 years ago, a senior U.S. Treasury official gave a speech very similar to this, calling on the IMF and said the IMF was asleep at the wheel and dealing with imbalances. Hank Paulson started the Strategic Economic Dialogue with the Chinese. Every Treasury Secretary since then have had an approach. So how will you do this differently, and how do you think that you'll proceed in this approach? What is your philosophy? What is your tools, and how will you execute on this?
Well, look, I think that our move toward reordering the financial or trading system is a start. I think that today, as I reaffirm our engagement, but set up a list of core principles and back to basics for the institutions. And again, being from the private sector, we want to see results. And we want to see timelines that, as you and I were talking about backstage, global rebalancing has been a topic for more than 20 years. Long time. And it's some countries may have a 100-year perspective. We don't.
Right. China obviously is an important part of this administration's foreign and economic policy. You'll be meeting with your Chinese counterparts. What will you tell them in the sense of how they obviously are aware that there's huge imbalances, their manufacturing capacity is enormous, especially in things like automobiles. How will you help them understand that it's not just about talking, it's about executing?
Well, look, I don't think I have to help them understand. I think they understand very well. And it's just a matter of impetus and will. So I believe I first went to Japan in 1990, 91, within 12 months of the peak of the bubble. A decade of that unwind, a decade of malaise. And then in 2012, I ran across a fellow, 2011, who was running for prime minister named Shinzo Abe, and he knew that Japan needed change and implemented it very quickly. 10 years later, more than 10 years later, Japan has had a remarkable economic run, and I think that our Chinese counterparts that will come to this realization. And if some of our policies, sometimes it takes an external push. Right. Alternatively, what I have said previously, there is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, I think they use the term dual circulation. Right. Well, right now it's really singular circulation. And if they want to rebalance, let's do it together. This is an incredible opportunity. And I think if Bridgewater founder Ray Dalio were to write something, he could call it a beautiful rebalancing.
Indeed. But a big part of that will also be our own fiscal imbalance. And as you mentioned, we're running deficit 6% of GDP at the top of the cycle. Not sustainable, as you yourself have pointed out. How important is it to also address our fiscal imbalance as part of this larger rebalancing?
Well, it's very important that I think most people in this room are trained economists, and everyone knows that a trade deficit emanates from three things. External trade policies, which we are intent on addressing, and the external trade policies can be tariffs, non-tariff barriers, currency manipulation, and the state subsidy of labor and means of production. So terms of trade or trade regulation is one. Two is our budget deficit. So the larger our deficit, the more it creates a demand suck, also pushes up the interest rates. And then three, the level of the dollar. The U.S., we continue to have a strong dollar policy, and the dollar will adjust based on markets. Everyone asks me, well, what does a strong dollar mean? And to me, the strong dollar means having the policies in place to deserve capital flows and have confidence. But it doesn't mean that the price on the Bloomberg screen every day. And it also has different meanings in terms of bilateral the prices. So it's really three-pronged. But Tim, to your question, I have talked about we did not get here quickly with the spending. The U.S. does not have a revenue problem. We have a spending problem. And I have suggested when I first met President Trump to talk about joining his campaign 2 years ago that we need to get back to a long-term sustainable budget deficit of something with the 3 in front of it, which works. We have 2% nominal growth or 2% inflation, projected 1.8% growth, which I think could be much higher if we implement our economic policies.
You reaffirmed the strong dollar policy first articulated by Bob Rubin. Valerie Giscard d'Estaing in the 1960s talked about the U.S. exorbitant privilege of the dollar. There are some in this town who question that privilege and actually see it as a burden. Do you see it as a privilege?
That the U.S. sits at the center of the global economy is enabled by the use of dollars, and that it's natural that the usage would come down over time. And I think that the U.S. will always, for my lifetime, be the reserve currency. I actually am not sure that anyone else wants it. I can't remember, one of the European officials said today, maybe it was Mr. de Guindos, I can't remember, said, oh, well, the euro could become a second reserve currency. Well, we've just had a substantial appreciation in the euro. For export economies, it's a lot of pressure. And look, I think that the reaffirming our belief in these international institutions is also part of that.
You mentioned the euro. You mentioned in your comments Mario Draghi's report from last year. There was the letter report. Before that, I've been spending a lot of time in Europe. There does seem to be a much more buoyant atmosphere in Europe. They see this as an opportunity for them. I said something about a possible renaissance. I was heckled a bit, but I actually am pretty positive on Europe. Do you think this is an opportunity to shift some of that demand? The world has relied on U.S. final demand to shift some of that demand for Europe. Is this a positive time for Europe?
Look, I think it can be, and it wasn't in a straight line. It wasn't always the way a trained diplomat would have done, But I think we should all congratulate President Trump. He has done what a succession of European leaders have tried to do for the past 26 years, since the advent of the euro, that whether it's the French, the Italians, other European countries have tried to get Germany to increase their fiscal spend and drive the European economy, and that I applaud these nascent efforts, because it's a combination. It's a combination of economic stimulus, and it is a combination of burden sharing on the European continent for defense. And as I've said many times before, economic security is national security is economic security. So if this European plan works, that I applaud it. I had a private meeting with the Spanish finance minister last week, 2 weeks ago, and he said, you're going to be pleasantly surprised with where we go on military spending, and that this 2% number today, he was right.
So you're already taking on these tasks. You have China, more consumption, less investment, deal with their manufacturing excess capacity. Europe is a great opportunity. The U.S. rebalancing here, including on fiscal. So what do you want the IMF to do? What would you like to hear from Kristalina over the next couple of days, or the board, and the new direction, again, back to factory settings direction? What do you want to hear from them?
Well, again, I think it's just been mission creep. Yeah. And just occasionally you have to trim your garden when the weeds grow. And I think that it's back to basics. What are our priorities, and how are we going to judge success?
And the World Bank, you discussed about graduating the medium-sized countries that should have graduated some time ago. That changes the commercial model of the World Bank, but obviously you think that's important, that they need to be graduated.
Yes. Yeah. I mean, it's just, as President Trump says, it's common sense that you can't have the second largest economy in the world, and it's as I said in my speech, I applaud their rapid growth, but you don't get both. I have a teenager who sometimes wants to be treated like a child, sometimes wants to be treated like an adult, and
I got one of those too.
Yeah. And it's an adult economy.
You mentioned energy, specifically nuclear, during the campaign, and since you've become secretary, you've talked about energy production is one of your important legs. The U.S. produces about 13 million barrels of oil a day, the largest producer in the world. What more do we need to do here, and how can the World Bank, what do they need to do more to encourage fossil fuels as well as nuclear, and I assume all the above?
Yeah, look, the sine qua non for economic growth is energy abundance. And we need to drive the right combination of the crawl, walk, run for these countries in terms of sustainable production. But by sustainable, I mean robust and baseload, right. Not what I would call almost a luxury belief that we have in the West. Like they are worried about pumping water. They are worried about heating their homes, running their hospitals, and we've seen that the intermittency doesn't work. Even kind of in middle developed countries, maybe like South Africa, that seems to have rolling blackouts. Right. So that's not a model. We want to have a model of strong baseload and then bolting on the alternative production, as opposed to beginning with alternative production and then having this latency or intermittency that makes it impossible to industrialize.
In the final minute or two, let me just turn to financial intermediation. You know, there's a famous adage that capitalism without capital is just another ism. The institutions you see here are important intermediaries, both in the capital markets and in other forms of financial intermediation. What is your vision, especially for the U.S., in terms of financial regulation? What do you want the industry to look like? Obviously, the capital markets, the U.S. is a crown jewel of this economy. How should we encourage that not only here, but abroad?
Well, look, I think that I've been getting a lot of questions on private credit, and I think that private credit is an interesting addition to the U.S. mosaic, and it is the depth and breadth of our capital and credit markets that powers the U.S. economy, and it's the innovation there. I think that private credit's a very new and interesting part, but it is happening outside of the regulated ecosystem. Right. And I always like to say, I'm not an economist, I'm an economic historian, and I think that is a distortion of the system, and it tells me that the post-2008 regulatory corset is too tight on the regulated institutions, and we want to deregulate them or make them more able to provide the opportunity to lend to the American economy and perhaps into the international economy in a smart, safe, and sound way. As we've seen, the history of financial crises is a overreaction on one side, and I think that we had a regulatory overreaction. I convened something in the U.S. called FSOC, the Financial Stability Oversight Council, which convenes the regulator partnership with the 3 U.S. banking regulators of Federal Reserve, Controller of the Currency, and the FDIC. We can come up with a system that makes the regulated financial system prosper again. And what the U.S. has that is different than most other G7 countries is just the number of financial institutions. We don't have 5 big banks, 3 big banks. And in the U.S., the community and small banks, which are provide 70% of agricultural lending, 40% of small business lending, 40% of real estate lending. And in the U.S., we've had this incredible boom on Wall Street. I think Wall Street can continue doing well. But I think it's Main Street's turn to share in the prosperity. And I think it was the pullback by the small banks, the post the GFC, that's kind of created this stagnation on Main Street. And we're determined to fix that.
Mr. Secretary, I always say Treasury is the sober voice of reason. What we've heard today from you is a sober voice of reason. We wish you all the best. Ladies and gentlemen, a round of applause for Treasury Secretary.
Thank you.
All right, that was U.S. Treasury Secretary Scott Bessent participating in a Q&A session with the Institute of International Finance. The president there and CEO Tim Adams having a little conversation about the economy, about trade policy, and we want to, get a sense of kind of where we go from here. Let's bring in our next guest, Stuart Paul, U.S. economist with Bloomberg Economics. Stuart, it seems like Secretary Bessent and even the president in his most recent tweets and social media posts, I guess seemingly pulling back from some of the most, stringent tariff requirements. How are you guys reading that from an economic perspective? Is the U.S. trying to be, I guess, less confrontational from a trade perspective?
I think the U.S. is trying to be a little bit less confrontational, especially when it comes to dealing with our global trading partners that we need to offset what we typically would get from China. And I think that that's an important thing to keep in mind when we have, let's say, a universal tariff of 25% or an average effective tariff rate of 25%, and that's relatively evenly spread across all of our trading partners. That gives us a relatively limited ability to substitute across sources and across suppliers. When we ramp up our efforts to combat China with tariffs, with trade barriers, and we lower our trade barriers everywhere else, we are becoming less confrontational globally. We're directing more of our efforts specifically towards China, and in doing so, we open up other sources for inputs to production that we might need. So net, probably less confrontational, and we're just becoming more specifically targeted towards China. That's probably a good thing in terms of maintaining the global commercial order, but it also will make it an especially difficult lift when it comes to negotiating some sort of a trade deal with China, who's responsible for 11, 12% of our imports.
He did say that the goal isn't to decouple, but then as each day passes with no resolution or no dramatic lowering of tariffs, the viability of businesses and other things remain at risk. What can we expect? Like, how long can this keep on going, I guess, is the question.
Yeah, it's going to be a slow de-escalation. I think that that's the direction that we're going to be going. So you could talk about both the level and the direction, right? The level is things are bad. We are at an all-time difficult moment when it comes to our relationship with China, and especially our economic relationship with China. But in terms of the direction of travel, things are moving slowly in the right direction. And it can take years. It can last well beyond the Trump administration. As we saw in the first Trump administration, he imposed Section 301 tariffs. That lasted through the Biden administration with no material change. Now there's been a ramp up. We're starting to change direction, and the de-escalation process can take years.
So I guess, is Bloomberg Economics forecasting a recession?
We are not forecasting a recession at this point. We have very modest growth of just over 0.5% for 2025. The contour of growth is going to be determined in large part by what segments of GDP are driving quarter-to-quarter dynamics. So we know that in the first quarter we should see slow growth because we've front-loaded our imports of inputs to production ahead of tariff implementation. Then when uncertainty really hits, uncertainty really hits in Q2 and into Q3, we should see slower fixed investment growth that should hollow out GDP growth in the middle of the year, but probably not enough to offset the rebound that we'll get in net exports in the middle of the year. So the contour of GDP and the dynamics for the different components of GDP are probably going to be enough to just keep modest positive growth throughout the year, we think.
President Trump said that the U.S. was doing just fine, quote unquote, with Beijing and did not anticipate a, quote, hardball negotiation. What was your team's reaction? Did you anticipate that?
Well, it's going to be a hardball. I mean, the president can say whatever he wants, but the reality is that the metals, let's say, that we need for just base metals, inputs to production, raw materials for building buildings, for the electric grid, for battery production, they come from China. China needs a lot of food from us. They're going to try to replace U.S. food with, let's say, food from Brazil. So this is just a massive geopolitical upset that's going on right now. You do have to play hardball. You do have to manage your trading partners. You have to prohibit, let's say, geopolitical and economic promiscuity between trading partners who stand between the U.S. and China. And so it is going to be hardball for a while. Trump likes to say that he holds all the cards, to use a different analogy, but it doesn't entirely seem to be the case. Yes, China does need food imports from the U.S., and they've shown they're not going to retaliate one for one because they've only imposed, low double-digit tariffs on U.S. corn, for example, but it is going to have the opportunity to source food elsewhere. And so over the long run, it's going to be a difficult negotiation.
All right, we will stay on top of it. Of course, Stuart Paul, U.S. economist for Bloomberg Economics, joining us live here in our Bloomberg Interactive Broker studio. Still green on the screen. Let's get a reset here. A Bloomberg Business Flash with John Tucker.
Yeah, and it is risk on, Paul. Investors taking comfort from comments by President Trump that U.S. tariffs on imports coming from China will likely come down substantially, his word. He also backed off the threats to fire the Fed chair, Jerome Powell. Right now, we have 10 of the 11 major industry groups in the S&P 500. They are higher. That's being led higher by consumer discretionary, and that is home to Tesla. The results from their earnings, nothing to write home about, but what investors are focused on is the fact that Elon Musk is going to return to run the company as he diminishes his role at Doge. Tesla shares right now, they are up 8.2%. Keep in mind, since its peak back in December, The share is still down 46%. S&P 500, 174 points higher. That's up 3.3%, 54.61. Still, though, in correction territory, down over 11% from its peak earlier this year. The Dow Jones Industrial Average up 1,086 points. The Nasdaq 100 up 723 points. That is up about 0.4%. Meantime, Henry Allen at Deutsche Bank says investors should not give up on the U.S.
Even if this chronic uncertainty persists, I think after about 6 to 9 months, we will just start to get used to it as a fact of life. And I think although some of the American exceptionalism trade was perhaps over-egged at the end of last year, it's worth bearing in mind there's still, a lot of bullish fundamentals if we look to that kind of medium to longer term 5 to 10 year view behind America.
New home sales advancing for the month of March, even as the overall economic outlook dimmed. We saw a 7.4% increase in sales of single-family homes. And finally, more layoffs. Saks Global, they operate Saks Fifth Avenue and Neiman Marcus, laying off hundreds of workers this week, part of the effort to consolidate operations as those two retailers come together. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney, live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Coming up, we're going to check in with Craig Trudell, Bloomberg Global Autos editor, to recap those Tesla earnings. And again, just looking at the numbers, they missed on revenue, missed on earnings, missed on production. But that doesn't really matter because the big takeaway was Elon Musk saying he's going to devote more attention to the automaker. The stock of Tesla today up 7.9% on that news. So he told the market what it wanted to hear. We'll talk with Craig Trudell coming up. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul on Bloomberg Radio.
All right, Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live in our Bloomberg Interactive Broker Studio. That is in Midtown Manhattan. We're also streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Tesla stock's up just under 8% today. They came out with numbers last night, which were really bad, well below expectations, the worst we've seen in years. Yet the stock trading up because Elon Musk says that he will devote, quote, far more of his time to Tesla starting next month, and that's clearly what investors wanted to hear. Craig Trudell joins us, Global Autos Editor for Bloomberg News, joining us from London via that Zoom thing. So, Craig, is it just as simple as Elon's coming back, let's buy the stock?
Yeah, I think as our colleague Liam Denning put it, the cure for Musk's missteps is more Musk, apparently. So, I do think that there were a lot of investors who wanted to see him, sort of come back and devote more of his time. I think you can find people who can say that, that won't necessarily fix all that ails the company. And you do have to wonder when he was saying in the same breath last night that, he'll still, 1 or 2 days a week, advise for the administration just how much he's really going to step back here. I would be surprised to see him. He's not much of a sort of backseat driver. He likes to be in control.
And Tesla sales started to really slow even before Musk threw his weight around politics, and they also withdrew guidance for the year ahead. What are you going to look at now that he's back and we're getting more Elon Musk?
Yeah, I think, the first thing that comes to mind for me is given all of the challenges they're having with growing sales, around this time last year is when we saw the company make these really dramatic changes to headcount and restructure in this really aggressive way. I think Tesla cut quite a lot of employees last year. And do we see Musk, in his words, come back and be hardcore and sort of throw his weight around? Because I think that the challenge that we're going to find this company have until and unless they follow through on these promises for more affordable vehicles in the offing, and also I think vehicles that sort of are differentiated from just what they already have. They're going to have trouble continuing to grow, and so there's I think real concern about if they're just offering a decontented version of the Model Y and or the Model 3, is that really going to be enough to sort of move the needle and sort of tide them over until they make some headway on other efforts that are sort of going to take them more time, like say autonomous driving or robots?
So just with the core auto business, I know Mr. Musk would like the people to look to other parts of his company, but the core auto business, one could argue it's never been a tougher time to compete for them. You just think it just feels like China, BYD specifically, just kind of taken over the global EV market. What's the competitive landscape look for Tesla these days?
Yeah, I think that's a great point. The Chinese market is incredibly competitive. We're seeing, just this week, fresh indication of just how tough the sledding is there at the Shanghai Auto Show, where Xiaomi is turning lots of heads. It's sort of the Apple car that Apple decided they couldn't pull off making their SU7 that really has done well there. BYD continues to just go from sort of strength to strength and really dominate in that market. And Tesla hasn't really had answers. They play in sort of higher priced brackets. It's not that they are falling apart there, but in terms of being able to sort of hang on to the position that they have, it's becoming more difficult when you have a fairly stale lineup and your competitors are sort of peppering the market with fresh product and innovating in a way that we used to kind of find Tesla was able to. The Chinese industry has really sort of taken up the mantle in this regard.
Can you talk to us more about how much of the tariff discussion was in the call, which took longer than usual? We have Musk saying it's pretty expensive to bring in things from China right now, and that he'll continue to advocate for lower tariffs. We know that this has hurt his business, which does a lot of production and manufacturing in China.
Yeah, it was a long call. It was a late night for those of us tuning in from London. So, you know, I was a little bit surprised, I would say, to hear Musk, you know, be as frank as he was about tariffs. He's, of course, a very frank person, but he has tended to be very careful about, you know, how and when he speaks about having any daylight between him and President Trump. But he was very, you know, sort of honest and open about this idea that he does not think that, you know, tariffs are the best approach to prosperity, as he put it. And, you know, while Tesla is somewhat insulated in that they make the vehicles they sell in the U.S., you know, in the U.S., and they have a plant in Shanghai that is massive and you know, a huge source of their exports for places other than the U.S. The company is still affected, and particularly on the side of their energy business, which has been a bright spot.
Right.
The fact that they import battery cells from China for that business is, you know, there's a big concern there.
Craig, excellent reporting. Thank you very much. Appreciate it. Craig Trudell, Global Autos Editor for Bloomberg News, joining us from London on Tesla. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up, a busy hour. We're going to start it off with George Ferguson, Bloomberg Intelligence Senior Aerospace Defense Analyst, going to talk to us about Boeing. They reported some numbers. Cash burn better than expected. Is this a turn for our good friends at Boeing? John Butler is going to join us, Bloomberg Intelligence Senior Telecom Analyst. AT&T out with some numbers, some pretty solid numbers, particularly after the weaker than expected numbers from Verizon. So maybe some market share shifts there in the wireless biz. Shelby McFadden, investment analyst at the Motley Fool, will discuss her market outlook. And then we're also going to go a little BNEF, Bloomberg New Energy Finance. We're going to talk about America's environmental markets and weather and what that means in the Trump administration. So I got a lot coming up in this hour. Let's kick it all off with the Bloomberg Business Flash. John Tucker.
All right, it's a rally on Wall Street, signs of easing trade tensions, at least for now, and a nicer tone from President Trump toward the Fed Chair Jerome Powell. That has investors jumping back into the pool. The S&P 500 up 144 points. That's a rise of 2 3/4%. We're at 54.34 on the index. The Dow Jones Industrial Average 900 points higher. That's up 2.3%. And the NASDAQ 100 right now up 639 points. That is a rise of 3.8%. Supermicro Computer, Amphenol Corporation, Westinghouse Air. Those are some of the leaders in terms of index points in the S&P 500 right now. And as earnings season continues, about 109 companies in the S&P 500 reported. Of those, 79% have delivered positive earnings surprises. Meantime, Julian Emanuel at Evercore ISI says investors are welcoming what appears to be some clarity from the Trump administration.
Several weeks ago, there were still questions as to whether the Trump administration was willing to tolerate a recession to achieve some of its aims. What we've seen in the last 24 hours and going back to the pivot in early April is that is absolutely not the case.
Among the data today, research firm S&P Global says American business activity expanded this month at the slowest pace since 2023. That implies a dimmer outlook. And Goldman Sachs' executive pay proposal, that has won a majority support from shareholders. Despite criticism, the bonuses were excessive. It won 66% of the vote in a non-binding ballot at the annual general meeting today. The CEO and the president of Goldman in line for a pair of $80 million retention bonuses.
Yeah.
Nothing to sneeze out there.
No.
What are you saying? They're worth it?
Sure.
I guess so.
Absolutely.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Isabel and Paul.
John, I'm a fan of the efficient market. You're worth what the market says you're worth. As simple as that. If the market says you're worth an extra 80 mil, good for you.
God bless you.
God bless you. All right, John Tucker, thank you so much. We appreciate that. We've got Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We are streaming live on the video thing on YouTube, so head over there. As John was just reporting, big move higher in markets today. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Denitsa Sakova. Denitsa, what are you looking at?
Let's start with Tesla, which after the earnings report we had recently, you wouldn't guess it's such a good day, but today it's actually up as much as 8.5%. Really strong day. It's actually coming, of course, of the news of Elon Musk pledging to retreat significantly from his government work and saying that his work at Doge is mostly done. We're seeing a very positive reaction. The car maker missed analyst estimates for both revenue and earnings. The management backed away from earlier predictions that vehicle sales will return to growth this year. So overall, pretty ugly earnings report. We saw the reactions on analysts, and overall, analysts have been turning really sore on Tesla since the start of the year. Of course, we saw earlier after the election, the stock saw a massive rally, but actually year to date is down about 40%, even with today's bounce. So, of course, the tariffs was a big topic that potentially Tesla will avoid them, and clearly this is not the case. Musk, of course, said on the earnings call that he has pushed against the tariffs, but that is definitely adding pressure to the company. But nevertheless, a good day for Tesla today.
What about Boeing? This stock has, I think, really struggled in the past, but I think today is a good day.
Yes, today definitely Boeing is seeing a great day. What we're, of course, Boeing was recently a winner in that competition, and also it reported first quarter results that exceed Wall Street estimates. The plane maker has obviously had a lot of trouble in the last couple of years, but it used about $2 billion in free cash in the 3 months that ended in March. That's better than the withdrawal we saw before that. Boeing shares jumped as much as 9% in earlier trading. Really strong day. They called 2025 their turnaround year. We're yet to see if this is the case. Of course, Boeing remains susceptible to the fallout from President Trump's tariffs. We've seen some news in China about halting aircraft deliveries, so everyone is on the watch. But today we're seeing a great day for Boeing.
In just a moment, we're going to check in with George Ferguson from Bloomberg Intelligence on Boeing. How about Philip Morris?
Philip Morris is also having a strong day, which actually is kind of surprising. They announced news about sale and separation, putting a pause on that $1 billion US cigar business. But the company is one of the big winners this year. It's up 42% year to date. It's really hard to see that big of a gain. This year, the stock is seeing another jump today, more than 4%. The tobacco maker has said that following the review and after taking account the market volatility and everything that's been happening, they're putting this on pause. But a lot of the optimism comes, as the company said, strong sales from ZYN nicotine pouches. They've been moving away from those from cigarettes and moving to smoke-free business, which includes ZYN, and that's accounted about 42% of their first quarter total net revenue. So that part of the business has really been boosting the stock, and we can see analysts are very optimistic, and performance year to date, it's really hard to beat.
It's amazing, 52-week high today, and as you mentioned, up 40% year to date. So pretty interesting. You can't keep tobacco companies down. I mean, no matter what, somewhere in the world, people are smoking, even if it's not in the United States. But it's just amazing kind of how those companies just keep chugging along. Denitsa, thank you so much for joining us. Denitsa Sakova, cross-asset reporter for Bloomberg News. We were talking about Boeing putting up some results that were a little bit better than expected, and I've learned from George Ferguson that I need to focus on the cash situation in this company, particularly their free cash flow, because they need to get the free cash flow positive sooner rather than later. And they made some progress there, is what my read is. So let's check in with the extra George Ferguson. He covers aerospace, he covers the airlines and all that kind of stuff for Bloomberg Intelligence. George, talk to us about Boeing. The stock's up 7% here today. What did your takeaways from their earnings?
Yeah, I mean, I think the biggest issue there was cash generation came in $1 billion better than expectations. I mean, I kind of get the sense that Boeing management has sort of, give us some pretty conservative estimates for cash generation for the year. I think they showed it in the first quarter, coming out pretty strong. I think there's a real good potential that Boeing could be sort of cash flat, meaning no usage for the year, or maybe even a bit of generation. And I think as we've gotten into the earnings call, what we've heard is the tariff effects are pretty manageable outside of China. China is a bit of a challenge, they know that. But again, a lot of the backlog is not Chinese airplanes. A lot of that's been, the Chinese haven't placed many orders, and Boeing's been sort of busy getting deliveries out to them to get some of those airplanes they've already built for them off the balance sheet. So China, the major issue, again, not big though. And the rest of tariff world sounds like where there's occasions that they have to pay, they're paying. They can claw back some of those costs from the administration. So it sounds like I would say things continue to be on track for a recovery, for a strong recovery, hopefully this year.
Yes, and Boeing last earned a profit in mid-2021, and it's definitely coming off its worst year in its century-long history. We have the CEO, Kelly Ortberg, saying 2025 is the turnaround year. What is Boeing going to do differently?
Well, I mean, I think they're going to deliver airplanes, right? So that's the biggest challenge. When you're an aircraft manufacturer and you stop delivering airplanes and you have quality problems, that's why they stop delivering. You're just not going to generate cash. They've really been trying to, keep the supply chain, I would say, warm by buying components from the supply chain, and that's why they've seen inventories balloon to like $87 billion. I got to check and see what it was on today's balance sheet, but last balance sheet, $87 billion. So, I mean, a lot of the turnaround is build those airplanes with existing inventory, means the cash generation for the airplanes they build and deliver ought to be higher than historically. Use that money to pay down debt, keep the balance sheet, or heal the balance sheet. That's the recovery plan.
George, I know from talking to you and reading your research, the cash story hinges in large part on getting those 737s out the door. Talk to us about where production is today and where do you think it's going to go in the future?
Yeah, so they said that the factory was building at low 30s number of aircraft per month. We'd kind of been tracking it. I think we saw high 20s, so probably Kelly's got maybe just a more current number on that. I think that they'll get up to the 38 limit. This is all on the 737 that the FAA has put in place for them this year and go past that. I think they'll get an FAA approval for that, and probably at the back half of the year, we're kind of looking for them to be 40-ish. And so again, that the more you use the factory, the more overhead gets absorbed over a larger number of airplanes. The more profitable you are, the more cash you're going to generate. Part of that story.
Can you talk to us a bit more about how much the tariff headwind will affect the company's top line or bottom line, especially with this really heated tit for tat, it seems, with China?
Well, so again, China has really become much less of an issue for Boeing. The Chinese have placed 16 orders this decade for airplanes. There's some 400 orders on the Boeing books still. That's of a backlog that's 6,000 large. Kelly Ortberg was just talking on the call that he's prepared to. He was planning on delivering 40 to 50 into China this year, so not a lot of airplanes. That would be mostly 737s, and that's out of an expected build of maybe 400 737s or so this year, so you can already see the sizes that large. And he's ready to go out and he's going to talk to the customers, see what they want to do, and he's ready to go out and remarket those airplanes. I think we've already seen Air India raise their hand, say, hey, we'd take some airplanes, and there's other folks around the world that just haven't got the deliveries they wanted. They're ready to take airplanes too. So on the top line, I just don't see China impacting things that much. The bottom line, again, Boeing said 80% of their supplier base is U.S. based. A lot of the other stuff is Canada and Mexico, which are under the agreement between those countries that allows things to flow without a tariff. And then there's cases where when airplanes are being sold overseas, they can claw those tariffs back.
Excellent, George. We got to go to some breaking news. George Ferguson covering the airlines and aerospace companies. Let's head down Washington, D.C. President Trump making some comments to reporters. Let's listen in.
A lot of money, so that's very good. Every country wants to partake, even countries that have ripped us off for many, many years. China is an example, but it's not just China. European Union, they ripped us off for many, many years. And those days are over. We're going to make a lot of money for our people. We'll be able to lower taxes substantially, and we're going to be proud of ourselves. They're not going to be a laughing stock that got taken advantage of by virtually every country in the world.
We thought you said you were going up to launch for a flag. What was going on?
We're putting up a beautiful, almost 100-foot tall American flag on this side and another one on the other side, 2 flags, top of the line, and they've needed flagpoles for 200 years. It was something I've often said, they don't have a flagpole per se, so we're putting one right where you saw us, and we're putting another one on the other side on top of the mounds. It's going to be 2 beautiful poles. Paid for by Trump.
When are the flags good?
They arrive in about a week or so.
Can you clarify, Mr. President, on China?
Yeah, we are going to have a fair deal with China. It's going to be fair.
Are you talking to them actively now?
Actively. Everything's active. Everybody wants to be a part of what we're doing. They know that they can't get away with it any longer, but they're still going to do fine. And we're going to have a country that you can be proud of, not a laughing stock all over the world for many years, and 1913, they traded to the income tax system. We used to be all tariff, and we had no income tax, and we had the wealthiest country we've ever had proportionately. From about 1870 to 1913, it was all tariffs, and we had more money than anybody. They had committees how to spend the money. They had so much money they didn't know how to spend. Then some brilliant person said, let's go income tax. Let's let the people pay. Now, we're going to be able to substantially lower taxes when this is finished.
So, how does it look in the meantime? Are you considering?
It looks good. Yeah, no, it looks good.
While you're negotiating?
It looks good. We were losing anywhere from $3 to $5 billion a day. Think of it. We're losing billions of dollars a day under Biden and other presidents, frankly. But under Biden, it got really worse. China got out of control. We're losing $1 trillion a year. Trillion, not a billion, not a million, $1 trillion. And now we're going to be making money with everyone, and everyone's going to be happy. But we're no longer going to be the country that's ripped off by every country in the world. Thank you very much.
A few words about the Pope, sir.
All right, that was President Trump in Washington, D.C., speaking with reporters about the upcoming the tariff situation, the economic plan that he and his administration are pushing forward, talking about making the U.S. government a fairer trading partner with our partners around the world, and that's kind of the goal of this administration. So the market certainly kind of likes what they're hearing in terms of maybe a more tempered tariff policy here from this administration. We've got the S&P up 2.75%, the NASDAQ up 3%. So we got the markets moving higher today. I'm looking at the yields here, the 10-year Treasury yields coming in by 7 basis points. So now we're at 4.32%. We did get down to as low as 4.25%. So movement as well in the Treasury market. The Bloomberg Dollar Index higher today, snapping kind of would have been a weak couple of months here for the U.S. dollar. Bitcoin, 93,300. It did get up to 94,600. So definitely a risk-on view to the market. Coming up, we're going to check in with Shelby McFadden, investment analyst at the Motley Fool Asset Management, to get her thoughts on the markets. Michael McKee, Bloomberg International economics and policy correspondent, will join us on U.S. economic data. And the latest from the IMF, he is down there in Washington, D.C. Lots of meetings going on down there with the International Monetary Fund and some other leading international economic and finance folks there congregating down there in Washington, D.C. So again, good day for risk-on assets. I'm looking at WTI crude oil just below $62 per barrel. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Off the best levels of the session for the major averages, but it is still a gangbuster rally. The S&P 500 up 139 points. That's up 2.6%. The Dow is up 845 points. The NASDAQ 100, 625 points higher. That is up 3.4%. You have chip makers and the financial stocks among those rallying alongside U.S.-listed shares of Chinese companies. And this comes after President Trump said China tariffs will drop if the two countries can reach a deal. Investors also kind of breathing a sigh of relief after the president seemed to back off threats to fire the head of the Federal Reserve, Jerome Powell. Tesla shares, can't mention that enough, rising after Elon Musk pledged to retreat significantly from his government work to concentrate on the company. Tesla, even though the results weren't anything to write home about, Tesla shares up 8.3% right now. Consumer discretionary, best performing group in the S&P 500. You have right now 9 of the 11 major industry groups in the S&P 500. They are higher. Best performing stock in the S&P 500, Connecticut-based Amphenol Corporation. This is a maker of electrical components. That is up 11.6%. You also have Air Brake, Westinghouse Air Brake Technology, the locomotive manufacturer, lifting the top end of its adjusted earnings per share forecast for the full year. It makes stuff for locomotives. And George Westinghouse, don't get me started on this, he has fewer patents than Thomas Edison, one of his contemporaries, because George Westinghouse let his workers take the credit for the work they did. Thomas Edison wanted the credit for everything.
Okay.
So, anyway.
Two ways to play the game.
Stick that in your pipe and smoke it. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business. They also had radio stations, too.
Yeah, Westinghouse.
Yeah.
Absolutely.
There you go.
Yep. Part of CBS Radio back in the day, now part of Odyssey.
Yeah.
All right, very good. John Tucker, thank you so much. We appreciate that. Isabel Lee, Paul Sweeney, Alex Steele's out today. She'll be back on Friday. Got some red headlines crossing the Bloomberg terminal right here. Treasury Secretary Bessent, he's speaking to reporters in Washington. According to Mr. Bessent, no unilateral offer from Trump to cut China tariffs. So just, again, another headline. You know, we're just kind of bringing them to you as they come. But the question is, you know, to what extent will the U.S. and China sit down and talk about the tariffs here? So we will keep all the reporting in front of you. The markets are moving, as John Tucker mentioned. Let's see what the professionals are doing. I mean, you can get whipsawed around here. I don't care who you are. Shelby McFadden joins us, investment analyst for Motley Fool Asset Management, located down in Arlington, Virginia. Shelby, how are you guys kind of day-to-day dealing with the volatility of this market? Again, we've got a VIX that's come in today, but still up near 30. How do you guys deal with the volatility?
At this point, we've really just buckled ourselves in. You know, that sort of overhead harness that you pull down when you're on a roller coaster? Yep. That's been our tool of choice. And it's mainly because the swings that we've seen in the market, they're usually the up and down swing tend to be about the same magnitude, down 900, up 1,000 the next day, or within 36 to 48 hours. And the other thing, too, is that the swings have been pretty broad, right? We're not seeing any major changes in sort of like relative valuations up until today with, you know, consumer discretionary outperforming. It tends to just be a really big sort of congealed swing in the market, which doesn't leave too much room for the sort of relative valuation opportunity. So we are watching the headlines a little bit more closely, not because we want to trade on them, but we're trying to be able to see where the dust is going to settle. And so I think today what we're seeing in the market is a reaction to the prospect that the dust will be settling soon. And I don't really expect there to be too much of an overreaction to Secretary Bessent's sort of follow-up headline. So yeah, I think as active investors, we have sat tight so that we can really get a better lay of the land and waited for the real opportunity to show up and not necessarily just move at every, sort of down opportunity, really trying to stay disciplined with what we believe to be fair value.
Sitting tight seems to be the consensus these days, but how are you allocating your funds? Have you shifted anything recently, cut something to overweight, or boosted something to overweight?
Yeah, that's a great question. In terms of allocation, what we have looked at is, I would say in terms of at the top, we've taken a look at what is our cyclical exposure. So whether that's going to be industrials or consumer cyclical, that was one of the first things that we had to look at really after inauguration. So at election, we pretty much had to sit down and said, okay, what are the main sort of like tax policies that we think are going to be the most impactful? But right now, it's more so been, okay, what is going to be the most sensitive to any sort of slowdown, because we've been back and forth, right, on whether or not we're going to be able to hold on to this soft landing that was so they worked so hard for, or is it going to sort of fall through our fingers? So allocation has been a lot more focused on, okay, the company's doing very well. We know that they're going to probably perform ahead of their peers, but we may want to pull back just a little bit because the growth is now going to be a little bit more deferred into the future.
So Shelby, there's, with all the tariff talk, it's created a level of uncertainty in here, which has sapped corporate confidence. We've seen companies pull back on some of their CapEx guidance and so on, and some of their earnings guidance. It's even impacted consumer confidence. We see that in the survey data, like the University of Michigan data. Yet a name on your list is American Express. That seems to be a play on the consumer. How do you think about American Express in this world?
Well, there's a couple things I really like about American Express. The first is they are in that sort of premium part of the spectrum. So it's a little bit stickier in terms of being able to maintain those revenues, being able to maintain that spend. So they're just, on the higher end of the credit spectrum. The second thing is more recent, and it came from their most recent earnings call, where management has basically said, hey, we're not going to be just full stop cutting our allocation of spend to things like product refreshes and reinvesting in the business just to pad earnings, right? They're going to continue to try and serve the customer and serve the business for the long term at a time when management of different companies, and rightfully so, are a lot more cautious. So it's not to say that they are sort of in the wild, wild west and thinking that they're completely insulated from any sort of macro issue, but also saying we've got the balance sheet, we've got the financial health to keep investing in this business, and we're going to do so. And as active managers, that's something that we really like to see, is a commitment to continuing to make the business better and serve customers up into a point where you say, okay, now we need to go ahead and pull things back. But not doing so prematurely is what keeps me excited about that business.
What about TransUnion? That's another company that you like. We know that definitely Americans are relying more and more on credit when it comes to consumer spending.
Absolutely. And so there's another dual-sided story to TransUnion as well. So one is, again, the increasing reliance on credit and debt, and also the need for identity verification goes along with that as well. And that is something that one of their peers actually did a lot more of, which is sort of what made the valuation a bit more attractive for TransUnion. Whether or not that sort of federal identity valuation market sort of starts to shrink is something that could very well serve TransUnion's valuation in the future. But the fact is they've been pretty robust up against this environment where we're not quite sure how consumers are going to behave. But increasingly, people are using more credit, not just because they need to stretch out the financing, but because of the rewards. So if you're looking at a situation where in the past, maybe you'd use credit because you had to, but now the younger generations are getting into credit early. They're using multiple different cards for multiple different purposes. Right. And that's going to require a credit check every time. And TransUnion does it most affordably.
Shelby, thank you so much for joining us. Shelby McFadden, investment analyst at Motley Fool Asset Management, joining us from Arlington, Virginia. Markets coming off of their highs of the day, perhaps in response to a comment just crossing the Bloomberg terminal that Treasury Secretary Bessent says, no unilateral offer from Trump to cut China tariffs, taking some of the wind out of the sails of the market. Let's get some details. Michael McKee, Bloomberg International Economics and Policy correspondent, down there in Washington, D.C. Mike, it's back and forth, back and forth. Whoever gets the last comment, whoever gets the last tweet seems to be moving these markets. Where do you think things are underneath as it relates to tariff discussions and strategy?
Well, if I were going to be completely honest, Paul, I would tell you I have no idea, because I don't think anybody in the administration has a clear idea of what the actual policy or status of things is. Scott Bessent, the Treasury Secretary, just got finished speaking at the Institute for International Finance. He talked a little bit about China and the idea that there is a long way to go there, but we can make progress. And he said afterwards, as you just mentioned, that there's no timeline for this. It could take 2 or 3 years to come up with a trade deal, which is not the impression that the president left last night. However, the president has just spoken over at the White House to some reporters, and he said that China and the European Union have been ripping us off, and we're going to get a fair deal. So it does seem that there's not exactly the progress on China that the markets had thought. The question is, what progress is there with other countries? The vice president, J.D. Vance, is out just a few moments ago saying that there are a number of deals that are close. Scott Bessent said maybe with India. The markets probably would like to see one of these predictions come true.
Based on your reporting, can you shed more light on Secretary Bessent's thinking when it comes to the firing or potential firing of Powell? Trump obviously said he had no intentions, but still, this made headlines for days.
And it's still making some headlines. Scott Bessent to reporters just a few minutes ago over at the IIF meeting, saying that he's not a lawyer. He doesn't exactly know what the president meant. It might have been that he's just referring to the end of Powell's term in May of 2026. And he said he would not want to comment on whether the president's statement last night is definitive, that there will be no effort to remove Powell before his term ends. So now that that's clear as mud, we're kind of back in close to the same space, except the president isn't threatening Powell as of this moment.
So, Mike, down in Washington, D.C., at the IMF, what are folks thinking about here? I mean, how are they kind of viewing this? Are they just like the rest of us? We're just kind of going day by day?
That is almost exactly the reaction you get from government officials, from finance officials, and from people who are just in the streets here. Everybody is shrugging their shoulders, saying they're exhausted and they don't know what to make of it all. It's very frustrating for people who are used to Washington moving at a very slow pace. In this case, Donald Trump is moving at a very fast pace. But is he going anywhere? That's the question, and it has got a lot of people confused. The IMF and World Bank meetings have brought together a lot of people from around the world, and the general consensus is we've got to figure something out here, because it doesn't look like the White House is going to be with us on just about anything. And yesterday, Kristalina Georgieva said, my advice to everybody who's coming to town is make sure that you individually are okay, because the rest of the world can't count on the United States at this point.
Yep. All right. Very good. Michael McKee, thank you so much. Michael McKee is international economics and policy correspondent for Bloomberg News. He's down in our Washington, D.C. bureau, again, at the IMF meetings, the World Bank meetings. Mike is reporting from there, giving us the latest here. Again, the S&P up about 109 points. That's 2%. It was up over 3% earlier. The NASDAQ's up 3%. It was up 4% earlier. So peeling off a little bit of the gains here this morning on perhaps the comments from Treasury Secretary Besant, who maybe throwing a little bit of cold water about some of the China tariff negotiations. So that's kind of the story of the day here. Where are we with tariff policy? And that seems to be shifting pretty frequently, so it is a fluid situation, and that's reflected in the market's performance here. Bitcoin, for what it's worth, is up $1,100, 92,300. How about that? This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages rallying today, but right now they're off the best levels of the session. This comes after the Treasury Secretary said President Trump hasn't offered to take down U.S. tariffs on China on a unilateral basis. The S&P 500 up 122 points. That's a rise of 2.3%. We're at 5408 on the index. The Dow Jones Industrial Average up 721 points. The NASDAQ 100 up 549 points. That is a rise of 3%. A busy day for earnings. Boeing's results, they beat estimates. Boeing shares right now 6.4% higher. Tesla rallying. Elon Musk vowing to pull back significantly, his word, from his work with the government. Tesla shares right now up 7.4%. Meantime, Terry Weissman at Macquarie says a number of issues will need to be resolved before what he calls American exceptionalism returns.
Tariffs is only one aspect of what is needed for the financial markets to be comfortable and feel secure in the knowledge that American institutions have integrity and are stable and are enduring.
Two-year yield right now 2 basis points higher, 382. The 10-year, the benchmark, down 6 basis points. That is at 433. CEO speak. Chubb CEO Evan Greenberg called for a coherence of policy, as he put it, to dispel confusion around President Trump's approach to trade, saying predictability is essential for economic growth. And then you have Virgin Atlantic Airways founder Richard Branson. Remember him? Slamming President Trump's tariffs. He calls them erratic and unpredictable, his words, that have knocked previously buoyant businesses into unknown territory. Virgin says it's hard to predict what the third and fourth quarters will look like as a result. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Well, that'll do it for me, guys. I'll see you tomorrow.
Very good, John Tucker. Again. You don't have to go. You're not worried about the fires. That's south of where you go.
Yeah, there are wildfires in southern New Jersey, which, if you don't know the area, it's all pine barrens,
Yep.
small pine trees, very flat, very sandy, and very prone to fires like that.
Yep.
But
All
no,
right. Certainly a big
the
issue.
Jersey Beach estate is safe.
Yep, all good. All right, very good. John Tucker, thank you so much. We appreciate that. So we are here in our New York Interactive Broker Studio. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. Let's talk about the carbon market. This is going to be under some pressure from the Trump administration. We know that. President Donald Trump triggered a sell-off in U.S. carbon markets with the latest executive order targeting state climate policies. Carbon prices plummeted as a result, but soon recovered after states affirmed their commitment to the program. So some uncertainty there as well. Bo Quinn joins us here. She is BNEF head of the Americas Environmental Markets and Weather. So talk to us about the carbon market. What is the carbon market, and what is U.S. policy regarding that?
Yeah, definitely. Carbon markets is one of the best ways to show a price signal for abaters to reduce their emissions and also transition the energy infrastructure in the U.S. So what happened in the U.S. carbon markets right now is that instead of more federal support for energy transition, we're going to need more state-based policies. And carbon markets is one of really these cornerstone policies that can drive us there. The main carbon markets here in U.S., there are currently 4. So we have the biggest one, California, which is on the West Coast. We also have Washington State, as well as the Regional Greenhouse Gas Initiative here in Northeast. So the California carbon market, it's more economy-wide carbon market, so it covers the power sector, the transport, as well as heavy industries, whereas Northeast here, we are more focused on the power sector as the single industry that we're targeting. So what really happened here is that we had a Trump issuing this executive order called Protecting American Energy from State Overreach, and it basically aimed for all state climate policies, not just carbon markets, but as one of his, I guess, favorite children, we got named as one of the main things to target first. So the carbon markets, of course, reacted to this, despite that this was partially expected. We wrote about this already last year, that with the election result, this is probably going to be something that we expect happening this year. And the biggest carbon market, so California, the price plunged 25% in after trade hours.
What's are carbon credits traded on the carbon market?
These are carbon permits, so it's
permits.
Each permit is worth 1 metric ton of carbon, and it allows the emitters in this scheme to basically emit that amount of carbon. So if you are you have ability to reduce your emissions, you can sell this allowance back to the market to someone who have a higher cost to abate and they need it more. And this is why carbon market is good, because it's not the state that tells the market what's the price, but it's more the market that defines what would be the effective carbon price.
So with this executive order, what is the base case outcome that you're expecting? I mean, markets are reacting poorly, so I would suspect that they're expecting something worse.
Yeah, exactly. So the executive order, basically it says 3 things to the Attorney General Pam Bondi. First, it told her to identify these state policies that are targeting climate change, targeting pollution and creating carbon costs, and potentially raise or damage energy affordability and potentially threaten national security. So first, identify these measures, and then second, to take action to stop the enforcement on those that are deemed illegal. And then third is to, I think now it's June 7th-ish, to give us a report on what are her recommendations on how to stop enacting these illegal activities.
So what are the states doing? Just take California, the 5th largest economy in the world. What's it doing?
Yeah, so the lawmakers have really gathered to back these programs. So Newsom also came to assure that he's committed to this program and said that this is more a glorified press release masqueraded as an executive order. And also we are expecting more action on extension of the program in a few weeks. But this really has a big impact on the carbon markets in US, because carbon markets in US actually had a huge surge last year. The prices have risen more than other carbon markets globally, and there has been large amount of investors, policymakers, but also industries being interested in how carbon pricing can really direct the future of energy transition and be also one of the assets that investors could potentially invest in, because it does hedge carbon, and it also hedges inflation and could provide alternative investment asset in addition to other.
All right, Bo Quinn, thank you so much. Really appreciate it. Bo Quinn, she's a BNEF analyst there, talking to us about the carbon market. Again, it looks like, no surprise, President Trump and his administration, definitely challenging some of the green energy initiatives that have been evolving in this country for some time, the carbon market being one of them. And perhaps the solution will be pushing some of that back to the states. So we'll see how that plays out. Looking at the markets here, let's start with WTI crude oil. I mean, Alex is out in Oklahoma, I think.
Wow.
Oklahoma. So she's at some conference there talking oil, talking gas with like-minded people out there. So we got WTI crude oil. That's off about $1.60. That's 2.5% down at right around $62. And the folks at BNEF have been telling us, the cost of production is around $55 a barrel. So they're getting down to that cost of production. And that's, if you talk to Mike McGlone at Bloomberg Commodities, at Bloomberg Intelligence, he tells you when you get down to the cost of production, that's really when you see changes in supply and demand. So we'll keep an eye on that. So WTI crude oil, $62 a barrel. Bitcoin up 1.6%. I'll give that quote for Tom Keene on the Upper East Side, just below $93,000 per token. Looking at the bond market, 10-year Treasury, 4.33%. Coming up, Justina Lee, Bloomberg Markets reporter, will get her big take story. Flash boys emerge from shadows. to shake up the stock world. Good headline there. We'll see what's happening in the equity markets with Justina Lee. That's coming up in just a moment. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Isabel Lee, Paul Sweeney. Alex Steele is out today, but we're here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Great. You know how we love these big take stories. Today's a great one, talking about the markets here. Flash boys emerge from shadows to reorder stock trading. I love that. Started my career on the block trading desk at Payne Weber back in the day, so I still have a soft part of my heart for the equity traders out there. Justina Lee joins us, cross-asset markets reporter for Bloomberg News, joining us from London via Zoom. Justina, talk to us about this article you wrote. Who are the Flash boys and what are they doing in the stock market?
Now, Flash boys, of course, was a term that Michael Lewis famously dubbed in his bestseller. And they're basically these high-frequency traders who make markets. You know, they're just buying and selling securities everywhere and kind of trying to make a small profit in between. And now, if you think back to the Michael Lewis book, you know, they were a pretty secretive bunch of traders. And usually they're just kind of silently on the other side of trades, kind of on exchanges, on algos. But kind of in my story that I wrote with Anna Herrera, we kind of wrote about how a lot of them are much less secretive. And that's because nowadays they kind of want to deal directly with money managers and cut out the exchangers and sometimes the brokers.
Justina is actually my teammate, and she's really so skilled in uncovering niche corners of the markets that I never really understand. But Justina, can you talk to us about the growing use of private rooms and how it's different in the US and in Europe? It seems like the trend has more significance in Europe.
Yeah, so private rooms are a kind of dark pool that is sort of almost a dark pool within a dark pool. And it kind of has this idea that, you know, a lot of people like to pick who they trade with, right? Like, for instance, you know, a market maker likes to trade with some asset managers who maybe don't have as much alpha in their flows, you know, or who are not kind of their fellow market makers. So kind of these private rooms allows HFT firms, allow asset managers to choose who they trade against, which if you think about it, kind of goes against the whole idea of an exchange where everyone trades with everyone. So it's a pretty controversial practice.
How much, do we know how much equity flow goes to these off-market exchanges?
Yeah, so in the U.S., actually half of equity volumes are now off exchange, and in Europe, it's around kind of even more. It's not. It's sort of not lit in the sense that it's not sort of an exchange where you can see all the orders. And I think that just shows, you know, people naturally want to hide their trading intention, and that's why they don't like exchanges. But it's a bit of a vicious cycle because without exchanges, you don't have kind of orders and prices that everyone can see at the same time.
You quoted someone from SIBO Global Markets, and he said that the growth of bilateral trading raises philosophical questions, quote unquote. Why is that?
And yeah, and I think it just kind of goes back to the controversy that I was talking about, right? Because when you have an exchange, you can kind of see the prices, you can see the buy orders and the sell orders. And so that, to a lot of people, is just kind of a more level playing field. And so when a lot of volumes move away from exchanges, that it becomes a problem of, you know, if I'm not in the private room or if I'm not in the dark pool, then how do I know what the buy and sell orders are? But at the same time, the regulator is in a bit of a dilemma because they're aware of that issue. But they also know that there's a reason why liquidity has been moving away from exchanges. And so they're trying to balance kind of these different interests here.
So if I mean, does this take business away from the Goldman Sachs, the Morgan Stanleys of the world?
Yeah, and I mean, in a way it does, because it used to be that if you're an asset manager, you send your order out to, you know, a Goldman Sachs or a Morgan Stanley, and then they either try to execute it on the exchange or they use an algo, and then the market maker sits on the other side of that. And now the market maker, you know, in this case, we wrote about, you know, Optiver in Europe. They're saying, why do we need the bank? Like, we're so big that we can just kind of establish a connection with the asset manager. And kind of in general, this whole model cuts out the banks.
So what does it mean for liquidity? What type of liquidity do we see in these markets? Because, you know, when I was trading for a sell-side firm, we prided ourselves on providing liquidity in a marketplace.
Yeah, I mean, on the surface, a lot of market makers would emphasize that, you know, it's not like liquidity is any worse these days. You know, it's not like bid-ask spreads are kind of blowing out. And I think what a lot of people have always been kind of wary of is that, you know, when you really need the liquidity, you know, when market volatility is spiking, like in recent weeks, I mean, are the HFT firms still going to be there, or are they just going to retreat? And I think that sort of is the question here. But it does feel like in these new bilateral arrangements, at least the asset managers can kind of get what they want, sort of for particular trades. You know, that's why they've been so popular here.
All right, Justina, great story, great reporting. Justina Lee, she's a cross-asset markets reporter for Bloomberg News. She's based in London, but that cross-asset markets team is global. We got folks here, we got folks in London, folks in Asia. They do awesome, great stuff. So it's really a great story. So you can read more of this story and all the other big take stories on the Bloomberg terminal and at Bloomberg.com/big take. Great reporting, we love it. Great topics, deeply sourced. They got a lot of resources behind there. And it's always some great reporting there. The market's still green on the screen. We are off the highs. However, the S&P 500 is up about just under 2%. The NASDAQ's up 2.8%. So still some strong moves to the upside here. Balance of power with Joe Matthew in Washington, D.C. That starts right after this global news update. Isabel Lee, thank you. We'll be back.
This is CBS News on the Hour, sponsored by Steel.
I'm Peter King. A warning to China and two international financial institutions from the Trump administration. What you think is working now doesn't work for the U.S. Treasury Secretary Scott Bessent says China's current trade model isn't sustainable.
China needs to change. The country knows it needs to change. Everyone knows it needs to change, and we want to help it change because we need rebalancing too.
Bessent tells the Institute of International Finance, the World Bank, and International Monetary Fund need to find better fits for their purposes and says the U.S. wants to work with them. China says the Trump administration needs to stop bullying and blackmailing trade partners. We have breaking news about a longtime U.S. Senator. Illinois Democrat Dick Durbin has just announced that he will not run for a sixth term next year. Here's CBS's Michael Wallace.
The 80-year-old Durbin is the number 2 Democrat in the Senate in his 5th term. He's also the ranking member on the Senate Judiciary Committee. His departure puts more pressure on his party to regain the majority in the Senate. Since 1984, his seat has only been won by Republicans for full terms twice.
A Palestinian student living in Vermont is due to be in court for his first appearance shortly. Mohsen Madawi was detained by ICE agents near Burlington a couple of weeks ago, but he hasn't been charged with any crime. This morning,
don't give up on Mohsen. We love you, Mohsen. We're here for you.
Supporters were outside the federal courthouse in Burlington. Madawi's attorneys want him released. They say he's legally a permanent resident of the U.S. and has lived in Vermont for a decade. St. Peter's Square has been filled with people waiting in line for hours just to get a glimpse of Pope Francis's coffin and pay their respects. Alex Leonard's of Atlanta was one of many Americans who felt compelled to be there.
It's such a surreal place, and it's very holy, and seeing the body and just remembering everything that he stood for is very important.
3 days of mourning have started. The funeral is Saturday. Hamas has released a propaganda video of an Israeli it's held hostage since the attack on Israel a year and a half ago. CBS's Linda Gradstein.
Omri Miran was kidnapped from his home in Kibbutz Nachal Oz in front of his wife and their 2 young children 18 months ago. In a statement, his family said that on the eve of Holocaust Remembrance Day, when Israelis say never again, an Israeli citizen cries out for help from Hamas's tunnels. It is a moral failure for the state of Israel, it continues. Israel believes that 24 of the 59 hostages Hamas is still holding are still alive.
Wall Street, the Dow has lost some of its early gains, but it's still up 544. This is CBS News. The nation's largest brick-and-mortar retailer is taking new precautions to stop shoplifters, this time in the meat section. More from CBS's Deborah Rodriguez.
Posts from Walmart shoppers showing tiny wire cages around fancy cuts of meat in the butcher's aisle have gone viral.
You gotta be kidding me. Walmart now has the steak locked up. It's come to this.
Major retailers across the country are testing new measures to combat rising shoplifting rates. No comment from Walmart, but earlier this year, the company's CEO admitted anti-theft measures were hurting sales. Deborah Rodriguez, CBS News.
The Declaration of Independence and the U.S. Constitution aren't just for the classroom these days. Booksellers say sales of the founding documents have surged to record highs since the start of President Trump's second term. Random House has just announced it'll publish new volumes of the Declaration, the Constitution, and the Federalist Papers. I'm Peter King, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Wednesday edition with markets rallying now on a major reversal from the White House, at least when it comes to China tariffs. We'll have details with new comments today from the Treasury Secretary Scott Bessent on this IMF week in Washington. We'll have a conversation about it all with economist Stuart Paul at Bloomberg Economics. Elon Musk preparing to wind things down in D.C. How about it? We're joined later this hour by Bloomberg's Ed Ludlow with Musk's plans following what was Tesla's worst quarter in a year. And as the president changes his tune on firing the Fed chair, we'll have analysis from our political panel. A lot to talk about today with Jeannie Shanzano and Rick Davis as Senator Dick Durbin of Illinois, the Democrat, announces his plans to leave Capitol Hill. It's all after a look at Wall Street. Let's start with those numbers right now. Feeling pretty good on the markets. Charlie Pellet, he's in New York. Hey, Charlie.
Hi, thank you very much, Joe Matthew. Yes, indeed, feeling pretty good, but let me put that in context. At one point, we had the S&P 500 index up by 3.4%. Right now, yes, we still have gains, but the S&P now up by 1.9%, higher by 100 points, 53.87 where we stand on that index. Dow Industrial is up 551, now up 1.4%, while the Nasdaq Composite Index ripping higher by 450. That is a gain of 2.7%. The 10-year at 4.35% with a 2-year 3.82%. Spot gold slumping 2.8%. 32.85 the ounce on the precious metal. West Texas Intermediate crude 61.93 a barrel, down 2.7%. And Bitcoin taking back the $93,000 threshold, 93,200 on Bitcoin, up now by 2.1%. So the Dow, the S&P, and Nasdaq are all advancing. Tesla shares higher after earnings, up 6.6%. Elon Musk vowing to pull back significantly from his work with the government and put more focus on Tesla, easing investor concerns about the car maker's worst quarter in years. Dan Ives is a senior analyst with Wedbush, and this morning he told us he has raised his price target on Tesla to $350 from $315.
I think the reality is Musk is Tesla, Tesla is Musk. And so much of that has been a positive, despite maybe some criticism. The last 3 months, the reason it's been a dark chapter, not just because of the quarter deliveries, but the brand damage and what ultimately Tesla became a political symbol. And I think it's a recognition that needs to end.
Dan Ives of Wedbush. So again, he's looking at $350 as a target on Tesla. To put that in context, Tesla right now, $253.80, again up by 6.6%. Recapping stocks higher, S&P right now up by 1.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Back we go to Washington. Balance of Power continues now. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you so much walking us through each turn in the market throughout the day. We'll get back to Charlie a little bit more and see a little bit shortly from now, I should say, to see how markets are faring. We have seen much stronger numbers today, but we'll take the green on the screen with a major reversal coming from the White House here. We were feeling pretty good yesterday. It wasn't until we actually got into the after hours period, though, and President Trump spoke from the Oval Office that things really seemed to turn around. Change of tune, call it what you will, gaslighting, a reversal. We are having a very different conversation now about when it comes to tariffs against China and the Federal Reserve Chair than we were even 24 hours ago. So here we go. Laying another layer of frosting on the cake today, Scott Bessent. Remember, it was his remarks that really turned things around yesterday when he suggested that this standoff with China was unsustainable and that soon there would be de-escalation. Well, President Trump took it a step further in the Oval yesterday, and then speaking here in Washington this morning in this IMF week, the Treasury Secretary out in front of a very influential crowd, answering reporters' questions as well at this international finance event, the IIF, Institute of International Finance in Washington. Listen to the Treasury Secretary.
I wish to be clear, America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
All right, there's your headline, right? America First does not mean America alone. And when we start talking about tariffs in China, this is where it gets even more interesting, as the President of the United States suggests they will be significantly lower than what we were talking about. The Wall Street Journal even put a number on it, saying it might be about half of what we're looking at now with the 125% tariff. So this is a different world we meet in today than it was even at this time yesterday. I guess the message from the White House, never mind. Could add Elon Musk to that too, as he wraps up the work at the Doge. And we'll get to that a little later this hour. Right now, it's Stuart Paul with us from World Headquarters in New York, U.S. economist at Bloomberg Economics. I'm not sure even where to start here, Stuart. We can kind of take our pick, I guess, on tariffs or the Fed share, but this is a president who's clearly backing off on both. He called him a major loser, right? Mr. Too Late, can't be terminated soon enough. He wasn't even sure, it seemed like, what reporters were talking about when they asked him last night.
Yeah, the comments around the Fed chair they've certainly varied through time. We know one thing for certain: Donald Trump likes lower rates from the Fed. If he can get lower long-term rates, that's even better. But I think that his advisors around him are clearly recommending that leaving Chairman Powell in his position until the expiration of his term in 2026 is the thing that would instill confidence in markets. I've often said there's no such thing as a free lunch in economics, but if there is one thing that's pretty close, it's an independent central bank. A central bank that's insulated from politics tends to deliver both higher growth and lower average inflation. And in a period where we're wrestling with the inflation and growth consequences of tariffs, the closest thing that President Trump could get to a free lunch would be to just leave Chairman Powell alone for the time being. Let him at least just wait out his term.
Well, it's interesting, the conversations that we're not always privy to here. There's a lot of reporting, Stuart, that it was Scott Bessent and Howard Lutnick that pulled Donald Trump back from the ledge when it came to the Fed chair. Pretty remarkable, though. We had Kevin Hassett talking just a couple of days ago about investigating, legal paths for dispatching the Fed chair. So at one point, this seems like this was real, no?
It certainly seems that way. One thing that I like to do is to pull apart the members of the administration, see who tends to have the most influence over the president and who's just repeating or parroting what the president has been saying. At a minimum, we know that Hassett is a very smart person, but he also just tends to parrot what the president has been saying. We love having him on Bloomberg programming, but it's a rare occasion when he breaks new ground. Somebody like Bessent does tend to break new ground every now and then, and to the extent that the reporting that we've been seeing, including from the Wall Street Journal, that Bessent and Lutnick have been leaning on the president to leave Powell in place is true, it would make sense given all the other policy priorities that they have to tackle right now.
Yeah. Asked in Washington today, Scott Bessent, I don't have a stand on firing Jay Powell. He went on to say, I'm not a lawyer. When asked about the possibility, it does sound like we've moved beyond this. And then you've got the matter of tariffs. Scott Bessent and Howard Lutnick trying to get time with the boss while Peter Navarro's in a room with somebody else. They pulled him back from the tariffs as well. Stuart, as an economist, and as you look at the market reacting to this, which of these seems to be the driver here? What has people feeling more optimistic? Is it the lifting potentially of tariffs on China, or the fact that the president's not going to try to fire or interfere with the Fed chair?
I think in the immediate market reaction, it's always going to be tariff policy over longer term, larger 30,000-foot issues like the independence of the central bank and the central banker's insulation from politics. I think that what really matters most are next quarter's earnings and how quickly we can move back toward a flatter tariff regime with our global trading partners. That's what's dominating right now. We did see a bit of a reversal yesterday in tone and sentiment where Bessent pivoted toward saying that there's going to come a necessary de-escalation in our trade talks with China and in our tariff barriers with China. But we did see him also say today, as he was leaving the IIF, that it could take 2 to 3 years. I think that that's even a bit optimistic of a time frame. I think that it could take even longer. We saw with the Section 301 tariffs implemented in the first Trump administration, those remained in place through the Biden administration. This is the sort of thing that could take a very long time.
So Donald Trump says he's willing to cut tariffs on China, referring to the 145%. If I said 125, forgive me, I wasn't even high enough. 145% would come down, but won't be zero. So then the question is, well, what are we going to do here? Where's this going to land, Stuart? The Wall Street Journal is pegging this at somewhere between 50 and 65%, quoting one senior White House official. If that, in fact, was the case, what would that mean for markets? Is that being priced in right now?
It seems as though it has been priced in right now. If you look to market expectations or the market implied expectations for inflation, for example, that's about where we are. Lowering the average effect, lowering the tariff barriers on China to, let's say, 50 to 60% would lower the average effective tariff rate to, and this is excluding anything on specific goods that would be in addition to the tariffs currently imposed on China. But if we were to lower the tariffs imposed on China to 50 to 60%, that would lower our average effective tariff rate almost in half, let's call it 15% from a touch under 25 right now. And that would result in upward inflation pressures of about 1.3 to 1.5 percentage points. And that's basically what's being priced in right now relative to baseline. So relative to our baseline expectations. So it does seem like markets are anticipating a walk back of these tariffs that have been threatened and, in fact, imposed already.
Incredible. That was like some real impressive back of napkin math by Stuart Bye. Did you see all that? That was live on camera. Very impressive.
The gears turning
This is
in
why we have to talk to the U.S. economist at Bloomberg Economics. Stuart, great to have you, as always. I suspect this is going to change again. We'll see what your thoughts are. But at the moment, it does appear to be a very different story when it comes to China and when it comes to Jay Powell. S&P 500 up 86 points. We've seen better numbers today.